I think we're renormalizing a yield curve if we've taken recession fears off the table.
As long as the underlying components and sort of drivers of inflation are still disinflation, I think it lets the Fed keep going.
They probably sneak in a cut in December, although even that's gotten to be a close call now.
I think that they can probably still go ahead and cut by 25 basis points in December, but next year is rather uncertain.
The objective has been to hold this soft landing, and now we're going to have melding.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
You've almost made it. Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with your equity market picture shaping up as follows. Equity futures on the S&P 500 down by around about 1/3 as we come into Friday, heading towards a week of gains without a single down day so far this week. Will we change that this Friday? On the Nasdaq 100, we're down by 0.5. If you want some fireworks, the wrong kind of fireworks, check out Euro-Dollar. Euro-Dollar earlier on this morning with a 103 handle, right now just about holding on to 104, 104.29. The latest out of Europe, growth revised lower in Germany, and the PMIs out of Europe this morning, pretty awful.
They were just terrible. If you look at France, the PMIs came in at the weakest since January. In Germany, the weakest since February, solidly in contraction in France, below all expectations. Now the question is, how much weaker can it get? George Saravellos of Deutsche Bank said, we remain very bearish on euro US dollar. Trump is only 30% priced, and this is the discussion over across the Atlantic.
And how much wider can spreads get across the Atlantic between Germany and the United States right now? If you check out the front end of the German curve this morning, we're down 10 basis points on a German 2-year. And the spread between the US and Germany back in September, about 135. Right now on my screen, 232. We are aggressively wider over the last month.
This is the right point, especially at a time where people are suddenly starting to price in a 50 basis point rate cut next month at the next ECB meeting. The question is, we've forgotten to talk about decoupling. People just sort of expect it to happen. And now the question really is, how wide can that division get at a time where there is a secular and frankly existential question facing the euro region that Christine Lagarde put out there? We're not keeping up with innovation, and secular stagnation very much on the table.
Let's make it really simple this morning. Just listen to the difference in the conversations in Europe and the conversations in the United States. In Europe, they're talking about a 50 basis point reduction in December. In the United States, Deutsche Bank's Matt Lazzetti saying that after December, this Fed's on pause for the whole of 2025. Why? Because of policies out of the United States. And we're still playing Game of Thrones. These are the names, you know them well by now. Walsh, Besson, Rowan, Haggerty, there's 4 on the screen. Wall Street Journal confirming something that Anne-Marie's been talking about all week. It's not Game of Thrones, it's potentially Game of Moving Thrones down in Washington, D.C.
Yes, exactly. The Wall Street Journal this morning on the front page, something that we've been reporting for a few days, and potentially this tie-up, which could see Kevin Warsh at Treasury coming into the Trump administration with Scott Bessent at NEC. And then when Powell is up and exits stage left from Fed chair in 2026, then maybe Warsh could go to the Fed and then Bessent can ascend to Treasury, which we know that he's definitely in the running for. But this is just potentially one pair up. We're still waiting on the final decision from President-elect Trump.
And really all this comes down to the same issue that we keep talking about with the division between Europe and U.S., which is all of these candidates are going to some degree, try to placate Donald Trump and his wish for higher tariffs and, frankly, an America First kind of agenda. How do they do that while keeping markets calm to the point of deficits, as well as potentially to the ideas that they have to put forward?
America First and Europe hurts. Euro-dollar right now, 104. Coming up this hour, this is the lineup for you. We'll catch up with Dom Konstam of Mizuho on the potential impact of Trump policies. We'll speak to James Lucier of Capital Alpha Partners on the President-elect's Treasury Secretary pick. And we'll catch up with Dan Greenhaus of Solus Alternative Asset Management on why he isn't worried about tariffs. We begin this hour with equities taking a bite out of this week's advance. Traders are weighing the potential impacts of a second Trump administration. Dom Konstam of Mizuho writing, Trump unified government likely changes the dynamic around the Fed, rates and the US dollar. However, it'll take time to be sure to what degree. Obvious first-order changes are that term premiums should be higher on higher net Treasury supply. Dom joins us now for more. Dom, good morning.
Good morning.
Word of the morning, divergence. How much divergence can we expect between the United States and Europe throughout the next year?
Well, probably a lot more, obviously. I mean, the main thing is obviously the impact, I think, on the dollar of the tariff policy, and it could be substantial. I think I would sort of say that, believe it or not, there's a lot of logic to what the Trump administration is likely to do on tariffs in terms of balancing that with the fiscal giveaways as well, the tax cuts. But the key thing actually is to have a stronger dollar, because then you sort of ameliorate the effects on inflation. So basically you pass the instance of the tariffs onto the exporters. And that does mean a much stronger dollar versus not just Europe, but obviously Asia as well.
You said there's a lot of logic. Share that with us. What is it?
Well, I mean, the logic is basically if you just have a stronger dollar, your terms of trade kind of deteriorate in the sense that the consumer the consumer in the US will do relatively well versus the countries that are exporting to it. If you bring in tariffs, then you basically transfer that benefit to the consumer to the federal government, which is what the Trump wants to do, and then you give it back to the consumer through tax cuts. So that's a kind of a nice sort of circularity there. The only problem you have is sort of the politics around it. To the guys who are paying the extra tariff and not getting the benefit that they would otherwise get from the terms of trade improvement, are they getting the tax back to them? So if you are a big importer in Arkansas who does a lot of, is on a pension or getting tips in the restaurant, then, maybe you're okay. But if you are not getting those tax back and you're in the East Coast, you're not doing so well. So it's going to be a political issue, a redistribution issue. But that is some logic. What you don't want, by the way, is you don't want the dollar not to go up, because then if the dollar doesn't go up, you basically do have that very bad inflation growth trade-off. And so in a way, the dollar is the cleanest way of playing not just the tariff story, but this tariff fiscal sort of tax giveaway story.
That logic explains why the U.S. is gain as everybody else is paying, in particular with Europe.
Yeah.
Can we take this a step further and talk about how this will actually keep a lid on U.S. yields, even with, fiscal profligacy, at a time when that sucking sound, as Mohamed El-Erian has talked about, has just all the cash moving into the higher yielding universe, which is the United States. You could see global bond funds completely dominated by U.S. bond funds over the past week with money coming in. Western Europe saw outflows from their equity markets. U.S. equities saw huge inflows. I mean, again, just absolutely a gravitational force, even with some of the concerns about fiscal spending.
Yeah, so, there are kind of two things. First of all, before this whole election thing, we have been in a world where yields kind of need to come down, even in the US. I disagree with the idea that the Fed is not going to be cutting rates in 2025, irrespective. It's going to take a while to see the impact of all these Trump policies on the US economy. Meanwhile, we are in a restrictive stance, and the Fed is going to be bringing rates down. So the question is, where do you anchor the yield curve? So let's say you anchor it at 3% short rates. Then, the longer run issue is what happens to the long end. And that then comes back down to how the US decides to fund the deficit, because the tariffs won't cover the deficit. You're still going to have a very big shortfall. So how that funding takes place will affect the long end. And then meanwhile, if the rest of the world is, if you like, taking the burden of this tariff policy in terms of weaker growth, and you look at Europe and all the problems that they have, then obviously there will be a sort of a reach for yield elsewhere. And if we have a steep yield curve, a lot of the foreigners will come back and they'll be attracted to our yields again. Right now, we don't see a lot of foreign demand because our yield curve is inverted. That's a problem. So you will actually end up getting lower yields anchored initially by a lower short rate. But, in the end, obviously, they're not going to come crashing lower to 2 or 3%. They might hang out at, like 3 to 4% for a while. So that's the kind of story I would see. Bull steepening initially, and then eventually maybe some best.
So are you painting a picture where somehow the American exceptionalism is a self-reinforcing cycle, while there can be relatively low inflation and growth, while the rest of the world is just feeling a whole lot of pain?
Through the strong dollar, absolutely. I mean, the worst thing you could have is if you didn't have a strong dollar, and then basically you end up with a sort of stagflationary impact from the tariffs. So all the negativity around tariffs, to be honest, is because people haven't really counted in the fact that if the dollar gets very strong, the consumer is going to be insulated. All you're doing is you're not giving the gains to the consumer they would otherwise have from a strong dollar. You're handing it to the federal government, which is fine if they're going to hand the money back. So in a way, US exceptionalism is sort of, there, and the guys who are going to pay the costs are the guys who have the big surpluses. There's no way that you can have a sort of a protectionist tit-for-tat that is ultimately going to allow countries that anyway run a surplus with the US to actually disproportionately benefit from that. They're not going to do that. They're going to suffer at the end of the day, and that is the whole game plan here. Obviously, to say, look, we've carried this for too long, and we want to sort of get something back for it.
But aren't you expecting retaliatory measures like we saw in the first iteration when China decided to stop buying American agricultural products?
A little bit, and maybe they can do better if they can target very specific areas that sort of kind of hurt, get more bang for your buck. But at the end of the day, if you're running a very large deficit, there's a limit to what retaliation can really do from the countries that run the surplus. I mean, that's the problem. So, and by the way, from a Pareto optimality, this great economic concept whereby you can redistribute, stuff around everyone and everyone's better off together, that's absolutely true. The whole principles of comparative advantage are absolutely true. The global economy is absolutely worse off because of this. But kind of as an American first, who cares?
I guess my point is, in the first iteration, there was a massive bailout that American taxpayers paid for when it came to the farmers because of the trade war. When you say be more targeted, does that mean you expect the Trump administration coming in to be more targeted about what they're going to go after in terms of tariffs, not blanket tariffs?
I think that's very important how they, exactly. I mean, how they approach the whole tariff thing. I mean, if you combine it with the China and the universal tariff, and then again, the giveaways, the fiscal giveaways back again are going to be very important to secure the political base. I mean, ironically, there was a Bloomberg article actually, because you can see who imports the most by state. And ironically, there's a good article that basically showed that some of the red states really were going to be disproportionately hurt by these tariffs. And so you've got to be careful that, you don't hurt the guys there who are voting for Trump. On the other hand, if it's all political and the swing states are going to be sort of better off, then kind of who cares? Because, Arkansas will never vote Democrat, but, Wisconsin, can vote Republican ongoing, then, net, that's the right political move. So
that's the politics. Let's finish on the markets. You talked about the importance of the US dollar. Is there a real risk that the deficit undermines the dollar's position?
I mean, I don't think so. As long as the Fed is willing and able to lower interest rates at the front end. So basically, you'll have, if you can have a steep, no one's, foreigners aren't really buying treasuries. Let's be honest. They're buying mortgages, but they're not really buying treasuries. They will buy treasuries if they can steepen that yield curve. And in the end, if you end up having, much flatter yield curves. In Europe and Japan, and of course, what does all this do? The ECB, how far can they take short rates? Well, only so far. And what's going to happen to the long end? Well, as you know, it's going to rally. So basically, in the end, you'll get foreigners back into our market. The important thing for the US, I think, and this is where the Fed chair replacement eventually comes in, is you need to anchor the yield curve lower by short rates. So whether they tell them to do that or the data falls the right way to allow them to do that in a credible way, either way. But you can always have the bill supply. I mean, at the end of the day, I think, you talk about the Treasury, who's going to be the new Treasury Secretary. It probably doesn't matter as long as they're very willing to increase the bill share of Treasury supply. And I imagine they will, and they'll do it quite substantially. And on that basis, you will end up with a relatively sort of lower yield environment.
You finished by opening the door to a much, much longer conversation about central bank independence and just how much cooperation there will be between these institutions. Dom, it's good to see you, sir.
Yeah,
Thank you. Thank you very much. Don Konstam there of Mizuho. Equities just a little bit softer this morning on the S&P 500. The highlight of the price action, the euro, dropping to 103. Levels we haven't seen since 2022 on euro dollar. Right now, 104.24. With an update on stories elsewhere with your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. President-elect Donald Trump has nominated former Florida Attorney General Pam Bondi to run the Justice Department. The nomination coming just hours after former Florida Congressman Matt Gaetz withdrew from consideration for the role. Bondi is a longtime Trump ally. Meanwhile, Japan's core inflation rate remained above the central bank's target, coming in at 2.3% in October. The data supports the Bank of Japan's view that underlying inflation remains solid and may lead to a rate hike in the coming months. Japan's cabinet also approved a stimulus package totaling around $140 billion meant to support low-income households, subsidies for energy bills, as well as investment into the technology sector. And look at shares of Gap. Those are soaring up more than 15% in the pre-market. The retailer boosted its full-year outlook because apparently wealthier shoppers are seeking value. The owner of Old Navy and Athleta now sees sales up 1.5% to 2%. That's up from less than 1%. Gap also telling investors the company's brands are growing growing market share across categories and said it was the 7th straight quarter of gains. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, searching for Donald Trump's perfect Treasury Secretary.
The president knows, the president-elect knows, getting the right person is more important right now than getting the pick done today or tomorrow.
That conversation up next, live from New York this morning. Good morning. Europe looking ugly this morning. Euro dollar specifically. Europe's always beautiful, but the euro looking ugly this morning. 104.20 before I start getting hate mail. 103 briefly earlier on. German growth revised lower. The PMI's just awful out of the Eurozone today. We'll break through the individual components of it in just a moment, but not great at all. A weaker euro on the screen once again. Under surveillance this morning, searching for Donald Trump's perfect Treasury Secretary.
He ran an economic agenda campaign. This is in his opinion, this is one of the most important, if not the most important pick he is going to make. So getting it right is important. The president knows, the president-elect knows, getting the right person is more important right now than getting the pick done today or tomorrow.
So here's the latest this morning. The Wall Street Journal reporting that Donald Trump is considering former Federal Reserve Governor Kevin Warsh for Treasury with an understanding he could later be nominated for Fed chair when Powell's term ends in 2026. James Lucier of Capital Alpha Partners writing, we will likely see a free trader at Treasury. Whether it's Warsh or Besant, the one who doesn't get Treasury will get NEC. Markets would prefer Besant, in my view, a serious financial markets guy who also speaks MAGA. James joins us now for more. James, before we get deep into this, I want your reaction to that Wall Street Journal story. It's something Anne-Marie's been talking about all through this week, that if he selects Kevin Warsh, it really is the appetizer for the main event for Kevin Warsh, which would be Fed chair further down the road. Do you think that is sort of reasonable from your standpoint? Is that what you'd expect?
I do think that's reasonable. And the Wall Street Journal is reporting what a lot of people have been thinking for a while, which is that we have a very narrow group of people we're looking at. Besant was the front runner. Warsh is coming up. It'll be one or the other. And it would be a very Trumpian compromise to put Warsh in the Treasury spot with the promise, if he follows through in that promise 18 months later, that he will rotate Besant into that position. You know, it reminds me of the Treasury switcheroo between James Baker and Donald Reagan back in the Reagan days.
James, though, if you put an individual at the Treasury who really wants an end game, his job at the Fed, does that compromise how the markets view him as a Treasury Secretary?
Well, it does. That's why I think the market would be more comfortable with Besant, but that's not the way Trump thinks. Two key principles about Donald Trump. One is proximity and timing. He can be, lobbied that John Farrow needs to be Treasury Secretary, and then someone walks in and says it's got to be Lisa, and he'll say, yeah, let's go with Lisa. So there are those surprising moves, but he also gets frustrated if he has a list of people that he's not entirely satisfied with. And I think that's what we're seeing at Treasury. The lobbying from Lutnick, from the MAGA community, that maybe Besant wasn't a sufficiently hard liner on tariffs. So Trump is frustrated there, and so he's looking at other alternatives. Maybe Warsh is that other alternative for now.
You did note in your notes, though, that Besant speaks MAGA. And I will say, yesterday we heard from the Bannon War Room really backing Scott Besant. This is an individual who has Steve Bannon and Steve Schwartzman lining up behind him. Who else in these names we're talking about has the MAGA base and also individual on Wall Street calling President-elect Trump saying, that's my guy?
It's hard to say. I don't really think that Mark Rowan has a MAGA presence, so to speak. It does help that Steve Bannon is coming out for Besant after Elon Musk came out against him and after Howard Lutnick came out against Besant as part of a contest for supremacy, a contest to get that top job, which Lutnick wanted badly. I'm frankly going to be very surprised if Lutnick is satisfied with being Commerce Secretary. So, unless somebody comes in out of the blue, it'll be one of the two. And while I did say that Besant seems to speak MAGA more fluently, Warsh does have a long history going back with Donald Trump, that Warsh might have had Jay Powell's job, and Trump has actually remarked, reportedly to Warsh that, I should have picked you instead of Jay.
Just like Game of Thrones, there are different threads. So there's the Treasury Secretary battle that's going on one hand, and then there's the issue of the rest of the cabinet picks, with yesterday Matt Gaetz withdrawing his nomination to become Attorney General. What do you make of that withdrawal? I'm putting aside some of the other cabinet picks and Pam Bondi, who has been selected to replace him. What's your takeaway from how this moves the chips around in the battle for what you call a revenge cabinet?
Well, the takeaway is that when Trump gets bored, he starts reaching out in new directions. I think the reason he picked Matt Gaetz to begin with is that too many of the establishment conservative Federal Society type lawyers he was presented with probably reminded him of Bill Barr. So he wanted somebody different, and that's how Gaetz got it. Now, Pam Bondi is a classic example of someone that Trump would be comfortable with, given that she is a Floridian, given that she's been a staunch defender of his, literally to the point of being his defense attorney during the first impeachment trial. Plus, she looks great on television. She's a very attractive woman, and that's something that Trump likes as well. But, she was elected statewide as Attorney General, the first woman Attorney General of Florida. So I think that from a MAGA perspective or a Trump perspective, she is a great pick. I distinguish the controversial nominees, the C5 that originally began with Gaetz, Hegseth, Tulsi Gabbard, Robert F. Kennedy, Kristi Noem. All of these people are cabinet secretaries dealing with agencies where Donald Trump felt deep frustration, where he felt the deep state was moving against him. So you could say these controversial nominees are literally his personal revenge against those guys. I think the other cabinet picks are very, very exciting in that most of these people, like Lee Zeldin and EPA, have no prior connection with the agency they'd be running, but they're there to shake things up, to dogify the government, to bring a fresh breath of air. And I think the others are probably great. Watching now to see what Pete Hegseth does, whether Hegseth can hang on and survive, because a lot of people, frankly, thought that he would go before Gaetz did.
James, a lot of people are saying, okay, so what kind of experience, just like you said, do these people have other than being on TV? And let me just tell you, that's real experience. So if you want to put ourselves forward for a potential selection, go for it. But there is this real question about the necessity of having spokespeople in these seats to really advertise what's going on. And actually, one of the big criticisms of the prior administration was people didn't hear from them about what was going on quite as much. How much is that actually a linchpin of Donald Trump's strategy?
Well, I think things have changed this time in that Donald Trump has had 3.5 years to sit around and stew about the failures and disappointments of his first term. For many issues in the first term, there were really no decisions made until late in the term. Decisions about what the tax reform would look like, an incredibly important decision for Trump. Decisions about the EV mandates, decisions about EPA regulations, decisions about whether to stay in the Paris Agreement. In short, they were slow to make the decisions, and they had people who didn't have a game plan when they went to the agencies. This time, I think they've made many decisions in advance. They've got a checklist of what Trump wants to do and what Trump wants to change. And while we've got good communicators in the role of top person at these agencies, I think this time there will be sort of the number two, the deputy secretaries, the backup people who do have a plan to execute on and a checklist. And they're going to take names. We'll probably also shoot first and ask questions later, figuratively speaking, of course.
Hey, James, appreciate your time. Thank you, sir. James Lucier there of Capital Alpha Partners. If the president-elect is watching this morning, I know sometimes he tunes in. Good morning. I've got 2 points to make. One, we need Lisa right here. And two, the news conferences would be terrifying. They'd be terrifying. Can you imagine what they'd look like with Lisa as Fed chair?
Okay, guys, we are so worried about the deficit.
Screwed.
We're just absolutely screwed. This trajectory does not work at all. I'm just waiting for the vigilantes to march in Washington, D.C. Everybody, get your packages ready.
Would that make you the most dovish central bank chair ever, though?
I don't know.
Would you accompany that with zero interest rates and QE forever?
No, because then that would cause inflation to rise.
So you'd
and I'm
be
also
like
worried about inflation.
5% sort the deficit out.
Yeah.
The problem's on you.
100%.
Bramo's going nowhere. Coming up next, Dan Greenhaus of Solus Alternative Asset Management. Frankly, I'm offended. From New York, this is Bloomberg. Still just about heading towards a week of gains on the S&P 500. 4 days and no losses so far this week. On the S&P at the moment, pulling back a touch. We're down 1/3% on the S&P 500. On the Nasdaq, we're down by 0.4. In the bond market, 2-year, 10-year, 30-year, just a little bit of a rally at the front end of the curve. We're down 2 basis points, down 3 on 10s to 439. A bigger rally out of Europe this morning. Check it out. Front end of the German curve. German 2-year, down by 10 basis points to 2%. The euro, a whole lot weaker, briefly 103. Euro dollar right now, 104.22. And a real conversation this morning about whether the ECB needs to reduce interest rates by 50 basis points next month.
Just to put this into perspective about how quickly that thrust is coming to the fore, today there is a 50% chance of a 50 basis point rate cut at the next ECB meeting. Yesterday it was 15% chance. Basically, the PMI data out of Germany and France has altered the conversation to really necessitate a faster speed for the ECB.
In 1 hour from now, we'll catch up with the Portuguese Central Bank Governor, Mario Centeno. Look out for that conversation. A man who's arguably actually been ahead of the curve relative to some of the other officials on the Governing Council. So that's worth a look in about 60 minutes' time. Under surveillance this morning, let's talk about that data out of Europe. Germany's economy expanding less than initially reported in the third quarter. The country's statistics agency saying GDP rose just 0.1% in the 3 months through September, down from a first estimate of just 0.2. A drop in exports holding back growth. Put that together with the PMIs out earlier on this morning, and the picture really isn't great.
It's secular stagnation. And Christine Lagarde, the head of the ECB, coming out and basically saying, since last year, Europe's declining innovation position has come more clearly to light. She's talking about the Draghi report almost, and echoing some of the necessity for there to be some sort of industrial plan, but also something to ignite competition. It just is unclear how quickly they can get that back to the fore to stave off some of the sucking sound that you hear of capital away from Europe, which you're seeing in the flows this week, and toward the United States.
She also is basically saying what we've been talking about this entire year on this program, was that the technology gap between the United States and Europe is unmistakable now. And then she's pointing to what's on the horizon, this geopolitical tension that is going to make the situation in Europe so much more difficult.
Let's turn to the eastern part of Europe and get you an update on some of the Middle East. We'll be talking about Ukraine and the latest with Russia a little bit later on the programme, so look out for an update there. I want to stick on some of the wars elsewhere. Unfortunately, we need to talk about this one. Israeli Prime Minister Benjamin Netanyahu saying he won't back down in the war against Hamas in Gaza. His comments coming after the International Criminal Court issued arrest warrants against him and a former minister. Netanyahu calling the move anti-Semitic.
So the United States is basically rejecting the court's authority, and they do not agree with this. They say the ICC issuance of arrest warrants against Israeli leaders is outrageous. That came from President Joe Biden. And then incoming President-elect Donald Trump's national security advisor, Michael Waltz, went on Twitter and basically said you can expect a strong response. So you see the United States going against the ICC. It's not a signatory of it, but this is a remarkable moment because you also see how hawkish Trump is going to be when it comes to making sure that the United States is standing behind Israel.
It also harkens to what David Malpass was talking about, which is that there's been a breakdown of some of these international agencies where you really are not able to hide the dissent and the lack of some sort of coalescing around a stance. ICC's view, Hungary's prime minister inviting Netanyahu to Hungary, even though ostensibly he should be arresting him. The expectation that maybe you'll get the same in other places. Australia denying to one of the Israeli ministers. But here is the question. What is going to be the relevance of some of these agencies in 5 years, 10 years, if you don't have some sort of gravitational force that their credos really hold in the entire world?
To your point, Lisa, increasingly losing relevance over the last few years, and that process seems to be accelerating over the last year alone. Let's turn to President-elect Donald Trump's search for Treasury Secretary. It continues. The Wall Street Journal reporting Trump is leaning towards former Fed Governor Kevin Warsh for the role, with an understanding he could later be nominated for Fed chair when Powell's term ends in 2026.
So everyone wins in this scenario. And we actually reported about this earlier in the week, that potentially individuals around Trump saw this as a solution to what they were dealing with, when at the moment then it was Howard Lutnick and Scott Bessent fighting for that role, bringing Kevin Warsh, who the president knows, who also has been a voice in the transition on economic policy. He can take that spot, for a year and a half. Scott Bessent is still in the room with the president, would be in the West Wing, someone he really knows very well, who's been on the campaign trail with him. But let me tell you this, the president hasn't made a decision, because if he did, we would all be talking about it. He has not made a decision, and yesterday the transition team was clearly preoccupied with what happened with this fallout of Matt Gaetz and having to move the conversation for a different AG. 8 days, 2 AG picks, not 1 Treasury Secretary pick.
And we're still waiting. And if this happens, if this Wall Street Journal story materialises, we have to talk about the conversation that Dom Konstam opened the door to earlier this hour. How much cooperation will be needed between Treasury and the Federal Reserve in the next few years?
Well, and Dom mentioned something else. He said that the likelihood that whoever comes in and is the Treasury Secretary needs to keep doing what Janet Yellen's been doing, which is to front-load Treasury issuance in the bill space, essentially not necessarily pressuring that long end of the yield curve, which is the opposite of what we've been hearing from a number of people who are the picks potentially. So you have to wonder how coordinated of an effort it is. Stay tuned to Monday.
That's quite a tease, Bramo. Looking forward to Monday. Is that to get people to tune in on a holiday
That's
shortened
what it feels
week?
like. I feel like there needs to be like a voiceover.
Is this a Sunday night
for
decision,
everything?
do you think?
I think maybe.
Well, you nailed it yesterday when you said Donald Trump is a producer. He is literally producing the picks. He wants them to be at a certain time of the day. You talk about it in the morning. I think potentially with a Treasury pick, maybe they're going to not do it during market opening hours. I'm not sure, but
Friday 5 p.m. feels like a graveyard for news, but who knows? Maybe it will be a little bit later. I've got no idea. Let's turn to the markets. Weighing the potential impact of President-elect Donald Trump's policies, including tariffs, Dan Greenhaus of Solus Alternative Asset Management isn't concerned, writing, "I'm less worried about trade, tariffs, immigration than most others. Perhaps there's a tinge of wishful thinking on my part, but I'm not as convinced those policies, coupled with the tax cut extension, is all that bad for the US, certainly in the medium term." Dan joins us now for more. Dan, good morning. It's good to have you back.
Good morning. Thank you for having me back.
Is it bad for everybody else?
Well, certainly on the immigration front, it's bad for some people. I think the point that I'm making is on the tariff front specifically, I go to these dinners, I go to conferences, you speak to people, and the tariffs are universally viewed through a negative lens. They're inflationary, they raise prices, they punish consumers, particularly at the low end. There's an element of truth to all of that. I think where I differ is, A, we've seen this movie already. We had tariffs during the first Trump administration, and I think you'd be hard-pressed to find in consumer data a meaningful reaction to it. Obviously, goods prices, which were in a steady decline, stopped going down. Even though headline CPI showed no real influence, goods prices, which are the items obviously most affected by the tariffs, did stop going down in a reverse course a bit. But I don't think you saw meaningful negative reactions throughout the economy. And part of the reason isn't to point two I wanted to make, which is if the currency adjusts, you can make a case, and I'm sure the Trump administration will, that there may not even be any price adjustment and tariffs actually will be paid by the exporting country. And again, that's a bit of wishful thinking on my part, but I think it's a differentiated take.
So we have to talk about some risks more broadly, but I think the deficit is a big, big focus. So the dollar is at the epicenter of all of this. If the dollar remains strong, a lot of people are going to agree with you. It can offset some of the pain. If you start to see some cooperation between a Fed chair and a Treasury secretary to keep rates low to accommodate a bigger deficit, is the dollar going to be robust, or does the dollar get sold?
Well, I think, currencies are a winner-loser situation. I mean, you in the intro tease, you were talking about Europe. I don't think the euro the euro area is looking particularly strong right now. By extension, the euro itself is not looking particularly strong. But I also think it's a bit premature to be talking about that when we don't have a Treasury Secretary and we don't know who will be the...
True, but is the market getting ahead of it? And maybe not in traditional foreign exchange markets. Is that what we're seeing take place in gold, in Bitcoin, more recently?
Yeah, I think probably the deficit and the worries about inflation are manifesting themselves in gold somewhat. Bitcoin's, I think, a bit of a different story, because this is going to be the Bitcoin presidency, or insert whatever phrase he wants to have a cabinet level position focused on Bitcoin and crypto. So I think there's a lot of enthusiasm and front running in a sense in the Bitcoin market. But listen, there's clearly concern about the deficit. My rebuttal on that topic is the same, and we've discussed this in the past, is I can find you headlines for 40 years of people concerned about the deficit, and here we are 40 years later, and we've had virtually no impact whatsoever.
There's sort of a larger point here, though, which is, are there limits to this grand plan that everybody can see and that essentially would benefit the U.S. to the detriment of the rest of the world, whether it comes to retaliation, whether it comes to people saying, all right, we're going to stop financing your fiscal expansion because we got to do it back home?
Well, listen, I think if you told the current administration or the incoming administration that the sum total of these policies would benefit the U.S. at everyone's expense, I'm not sure they would care, since that is, in effect, the desired outcome. This is a core tenet of the Make America Great Again platform. Are there limits? Of course there are limits, but I again refer to my earlier statement. Is 30 trillion in debt worse than 25 trillion in debt? Sure, but show me the evidence where the market cares. Is that worse than 20 trillion in debt? Sure, but show me the evidence. Listen, there is a limit, but I think in a standalone economy with able to print its own currency, et cetera, and this is true around the globe, you have less external constraints than you do if you are not fitting into those categories, and the U.S. fits into the former.
Can this happen all without inflation really taking up in a meaningful way in the U.S.?
Well, let's define inflation, and I think it's important for viewers and for when we think about this. The boogeyman is the 9% level inflation, of course. I don't think that's likely at all. I don't think the conditions are anywhere in place for that level of inflation. But if you told me that inflation's going to get stuck and is in the process of getting stuck in the 2.5% to 3.5% range, I think that's more than likely. I think that's probably your base case outcome at this point. The question becomes, does the Federal Reserve, does the Treasury, does the government do markets care about inflation, not at 2%, but at 2.5% to 3.5%? Most of those categories, I think, don't care. I think you'll have a lot of market strategists come on here and say, if you told me we're going to get all these great policies, or the policies will have all great outcomes, but inflation is going to be stuck at 3% instead of 2%, I'm not sure any market participants will come on here and say they care.
Dan, do you think the market cares about the face that's going to represent all these policies? Who's going to be the Treasury Secretary?
Yeah, absolutely. I mean, there's not a person on Wall Street right now not hashing out these different names. I don't necessarily have I don't want to express a personal preference on air.
But you have one.
Listen, they're all great qualified candidates, and I think we would all be terrific with any one of them.
I've been saying the same thing. Oh, wait, just in case I offend someone.
I, for one, welcome our coming Treasury overlords. But listen, I think clearly Kevin Warsh appears to be the front runner. You mentioned the reporting earlier. You talk to people around the street. I think maybe he is seen as the most down the middle, if you will, candidate of all the people mentioned. But Scott Bessent and Howard Lutnick also. I mean, Howard obviously is favored by the crypto camp. There's a number of people who prefer Scott Bessent.
He's out, though.
I'm sorry?
Howard's out, though.
Because I'm sorry, you're right, because I've forgotten it's 6:30 in the morning, not 7. And I forgot he's at Commerce now. But all the people being discussed, I heard Larry Kudlow's name thrown around a couple of times.
Mm-hmm. He doesn't want it.
I think there's all of these outcomes would be pretty good for market. There's not to be blunt, there's not a Matt Gaetz level Treasury Secretary being discussed that's not broadly palatable.
These are high caliber candidates. We've said that repeatedly all week. Can we just finish up by talking about valuation constraints across the board? In equities, much has been talked about the forward multiple north of 20, going on to the 2025 on the S&P 500. Credit, a space that you know well. Goldman said this on credit. Barring a sell-off between now and year-end, investors will likely enter 2025 with the most severe valuation constraints in more than 2 decades. Worth noting, that doesn't make them bearish, by the way. They think this market will still be supported. Where do you see the support coming from in 2025?
That's Lotfi. I had dinner with him actually last night. Goldman hosted a dinner. I was lucky enough to get invited. I think, not to make Lotfi's point for him, but I think, listen, you have high starting all-in yields in credit, 7% plus for the broad index or so, which is a pretty good starting point. But so that by itself is attractive for yield-seeking investors of all stripes. But to take the credit overvaluation or high valuation argument and the equity valuation argument, and let's just do equity because most investors are the point is broadly the same. We're at 21 times forward earnings or something like that. Fine. Why can't that go to 22? So if we're going to earn $300 next year, let's just say these policies end up being pretty positive, and you earn $305, $310, and the multiple expands one turn, I can get you to 7,000 in the S&P next year pretty easily. In credit, you're starting at 7% all-in yield right there. These policies work. The economy does well. Defaults remain low. Spreads tighten to all-time tights instead of near all-time tights. And you've got low double-digit return for credit next year. So I think a lot of this depends on how the economy performs. The number one input into any equity valuation model will be domestic, if not global growth. And as long as the economy holds up, I don't know why. Listen, valuations are elevated. We know that. And a disproportionate share of that valuation is being driven by the tech stocks being a larger share of the market right now. But if the economy continues to hold up, you're going to see this broaden out. You've already seen it. A host of the names that some of our best performing names are non-tech related this year. They're consumer focused. Some of the energy space has done well. Obviously, healthcare is having problems now. But before that, there's a lot of opportunity here, assuming the economy continues to grow and profits continue to grow. And I wouldn't spend too much time worried about valuations until it's time to worry about valuations.
We'll spend a lot of time worrying about valuations. Don't worry. Dan, it's good to see you. Dan Greenhaus of Solus Alternative Asset Management at 6:45 Eastern Time in the morning. We get very lucky. Thanks for waking up.
No, thank you.
30 minutes earlier than usual. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Bill Wong's 18-year prison sentence could be reduced to 11 and a half years. This after his lawyer argued the punishment was too harsh for the founder of Archegos Capital Management. Wong's lawyer urged the judge to let his client serve 6.5 of the 18 years in home confinement instead of behind bars, and the judge said he would consider the request. Meanwhile, Pennsylvania Senator Bob Casey has conceded to his Republican opponent David McCormick in a race that was so close it triggered a recount. McCormick was declared the winner by news outlets earlier this month, but the state ordered the recount because the margin was under 0.5%. Casey had held his Senate seat since 2007 and now cedes to McCormick, who before this led Bridgewater for more than a decade. And DirecTV is pulling the plug on its Dish takeover. DirecTV has notified EchoStar of its intention to terminate the acquisition. This after it failed to win the consent from bondholders for a key debt exchange. The deal would have created one of the largest pay TV distributors in the U.S. with a combined 18 million subscribers. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in 30 minutes. Up next on the program, escalation in Ukraine. Live from New York, this is Bloomberg. Live from New York City, equity futures right now down by almost 1/3 on the S&P. Bond yields lower by 3 basis points, 4.39. The euro a whole lot weaker. Really big downside surprises across the eurozone. Not just today, just across the board really. Over the last few months, euro dollar down to 104. Under surveillance this morning, escalation in Ukraine. Here's the latest. Russia conducting another drone attack on Ukraine this morning after using a new experimental intermediate-range ballistic missile just yesterday. Putin calling the attack retaliation for Ukraine using American and British-made missiles on Russian territory earlier this week. Bloomberg's Ollie Crook joins us now for more from Berlin. Ollie, good morning to you, sir. What's the latest?
Yeah, that's right, Jonathan. We heard directly from the Russian president yesterday saying two things. One, that explicitly this was retaliation on the use of U.S. and U.K. long-range missiles within Russian territory, a concession that Joe Biden gave earlier this week. And saying, second, that this is not an accident that this is happening right now, right? This is the week in which we've heard a new nuclear doctrine from the Russian president saying that he is sort of ready now to diminish the level at which it would be appropriate for the Russians to strike back with nuclear force. There has been a question about whether this was an intercontinental ballistic missile. The end of the story is here. This is a missile that traveled 1,000 kilometers from the Caspian Sea into Ukraine at a time also when it seems like Putin is ready potentially to come to the table and talk to President-elect Donald Trump about potential ceasefire negotiations. So it's very hard to distinguish how much of this is an organic escalation of this conflict, how much of this is both of the sides trying to get in a stronger position in order to have a stronger hand at the negotiating table with the great unknown of Donald Trump. We've heard from the Kremlin this morning saying we are in no doubt that the current administration in Washington has had the chance to familiarize itself with this announcement and to understand it. We should also say, however, that we understand from the Pentagon that the U.S. was alerted that this missile was going to be fired minutes before it was launched. We should also say, though, this has been a conflict that hasn't really moved the markets widely over the last few weeks. That changed this week. We have gold up almost 6% this week.
Started to see some moves this week, that's for sure. Ollie, thank you, sir. Bloomberg's Ollie Crook out of Berlin with the latest. A week full of escalation. To continue the conversation, Liana Fix of the Council on Foreign Relations joins us now. Liana, welcome back to the programme. Let's talk about the prospect of some kind of deal and whether President-elect Donald Trump can broker one. Is this making it harder or easier to broker a deal when he takes power in 2 months' time?
So the Trump camp has been very unhappy with Biden's decision to allow long-range strike missiles into Russia. But let's remember that this is a response from the Biden administration. This is a response to a Russian escalation, the North Korean troops in Russia who are fighting against Ukrainian soldiers. And the problem for Vladimir Putin in this situation is that he has a new nuclear doctrine, but that by now no one really believes his red lines anymore because he has them overstepped so often, and the more he lowers the threshold, the more difficult it will be for him to uphold credibility. That's what he's trying to do now, uphold credibility with a view to a new Trump administration coming in and potential talks. He wants to be seen as Trump as a strong nuclear superpower.
How quickly do you think we could see those talks once President-elect Trump is in office and gets his team in place?
Well, Trump might actually be surprised that it is not that easy to just based on his personal relationship with Vladimir Putin to get him to the table. There is no indication whatsoever in the Russian discourse, in the discourse around the Kremlin, that there is a willingness to make any concessions. So Putin will come to the negotiating table expecting capitulation. He is on the advance. He has the manpower advantage right now. But if Trump doesn't want to be the one who loses Ukraine, similarly, like Biden had this humiliating withdrawal from Afghanistan, he cannot allow a capitulation. So it might actually be much easier to negotiate, much more difficult to negotiate for Donald Trump with Vladimir Putin than he thinks right now.
If Moscow and Kyiv both know that they may at some point be forced to a negotiating table, how bad is it going to get in terms of the physical war on the ground?
Yeah, obviously Russia is trying to get the advantage right now, and they have all the means to achieve that. But what they want is they want to reach the borderlines of the 4 districts that they claim to have annexed in Ukraine, but don't really control. This is the minimum goal that Vladimir Putin wanted to achieve. So this is something to look out for. And on the Ukrainian side, obviously, they will be in need of a new support package at the beginning of next year at the latest. If that support package doesn't arrive under Donald Trump, it will be much more difficult for Ukraine to hold the line.
Liana Fix at the Council on Foreign Relations on the latest. Liana, I appreciate your time, as always. After a series of escalatory steps with regards to this war, started really a few months ago with reports that North Korean troops would be getting involved. It went from there to what we've seen over the past 2 weeks.
Absolutely. There's been a tremendous amount of escalation. All of this is leading up to a change of power, a transforming of power in the United States. And what does that mean when you have President Biden giving Ukraine something they've been begging for? The United States has been dragging their feet and allowing them to hit into Russian territory. At the same time, though, you have a president coming in that says, I want to end this war. So now you're going to have a tremendous amount of escalation because everyone wants to go into this potential negotiating table with the best hand they can play.
So what do you make of the question that we started the conversation with? Does it make it harder or easier for the president-elect to broker the deal that he'd like to broker?
I think it really depends on when he comes in. What is the status of the war on the ground? I would say you have to look at some recent polling in Ukraine that shows, especially among the younger generation, they are almost tired of this war. They are the ones that are going to the front lines. They are the ones that are losing their families, their fathers, their brothers. And that might put more political pressure on Zelensky, even more so than President-elect Trump.
Yeah, they want to end this. Coming up next on the programme, we'll catch up with Mohamed, El-Erian of Queen's College, Cambridge. We'll speak to MacGuineas of the Committee for a Not-So-Responsible Federal Budget. ECB Governing Council member Mario Centeno on the latest data out of Europe. And we'll speak to Raj Agrawal of KKR. Looking forward to a stacked hour still ahead.
We're still bullish on the U.S.
We've seen massive outperformance from U.S. assets here. Over the next few months, what we're going to see is continued outperformance of U.S. equities over the rest of the world.
I think Trump is going to care as much about the stock market these next 4 years as he did the first 4 years.
The bond market will call the tune for the stock market as well.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City. Here's your price action on the S&P 500, down just 0.1%, a marginal move lower on the S&P, a mild move lower on the Nasdaq 100. We're down by 0.25%, a big move lower on euro dollar earlier on this morning. 103 briefly. We're talking about levels we haven't seen in almost 2 years on the euro against the US dollar, 104.20, and the Y is very much in Europe. The why is bad data.
It's bad data coming out of both France and Germany. PMIs, private sector activity, business activity, falling deeply into contraction, into some of the lowest levels that we've seen since the beginning of this year, at a time where you already have weakness being priced in. Now the question is, it's not just an economic issue. It's how far can the ECB cut rates at a time where divergence is so much back on the table?
How far and how quickly? We'll have a conversation with a ECB official in about 30 minutes from now. And that's where the conversation will begin. Is a 50 basis point cut on the table next month? Beyond that, do you have to rethink the process of normalizing and start to think a whole lot more about becoming accommodative? Is the risk now moving away from inflation and towards disorderly disinflation, something that Deutsche Bank's been talking about now for quite a while?
So we have a response to those questions from ECB Vice President Luis de Guindos, who said, it doesn't really matter, 25, 50. It's less important. It's the trajectory, which is lower, a lot lower. We need to get there quickly. And that's basically what the market's been pricing in. 50 basis points now the base case for markets that are looking for some serious action. And maybe Mauro Centeno can weigh in on that, because he's been actually ahead of the curve.
He has been, in a big way. They're stuck between a rock and a hard place. The rock is the domestic European data. The hard place is what could be coming in the next 12 months from the US administration. And we'll get more clarity on that, I think, in the next several days, once we know who the Treasury pick is going to be. You all know the names. I'll repeat them once again. Bessent, Walsh, Rowan, Haggerty. Who's it going to be?
Well, we're hearing musical chairs when it comes to this Treasury pick. Potentially, we're going to get the name today. Yesterday, it seemed like the transition was really sidelined, dealing with the Attorney General. Wall Street Journal today has something that we have been talking about for days and also reported on, that potentially a solution to a problem could be putting Walsh at Treasury, Bessent at NEC, and then in 2026, moving Walsh to really his end game and goal in life, which is Fed chair, and then pushing Bessent to the Treasury. This is potentially one duo we could see, but Donald Trump has yet to make a decision. It's only $28 trillion of debt this individual's in charge of, so, I think he's taking his time.
Imagine how messy this could be, because it could be quite messy. We've had a conversation about the potential of having the shadow Fed chair. We would basically have one. We would know who it would be if they go forward with this plan and talk about it publicly. We would know who it would be. So we would put that much extra weight, I think, on every single word that would come from the Treasury Secretary, with the idea being that they'd be in charge of monetary policy just around the corner.
The line between the Fed and the Treasury has gotten muddier and muddier over the years, especially with the likes of Janet Yellen being at the Fed and then moving to the Treasury. Think about if you know it is going to be the same person in the same administration at a time where the strategies are so aligned. This is going to be in the history books a time where people look back at the U.S. experiment and say, how do you use fiscal dominance to exert the pain on everybody else while continuing to consolidate the gains in the United States with tariffs and not necessarily allowing rates to go too high?
Part of the reason we've got gold and Bitcoin at or close to all-time highs. Coming up this hour, we'll catch up with Mohamed El-Erian of Queen's College, Cambridge on the next Treasury pick. We'll speak to the Portuguese Central Bank Governor, Mario Centeno, on rising bets for a jumbo rate cut by the ECB. And we'll speak to Raj Agrawal of KKR on the big spend needed to power AI. We begin this hour with stocks inching just a little bit lower and Treasuries rallying. Markets still waiting for President-elect Donald Trump's Treasury pick. The three front runners remain the same: Scott Bessent, Kevin Walsh and Mark Rowan. Mohamed El-Erian of Queen's College, Cambridge, saying this on one of the picks: Kevin Walsh's professional career and writings would make him a strong presidential choice for Treasury and for the Federal Reserve. Mohamed joins us now for more. Mohamed, are you endorsing a candidate then in this race for Treasury?
What I'm saying, John, of the four, the one that I have followed most closely is Kevin Walsh. I've done that for almost 2 decades. And if you look at what he would bring to either or both jobs, first, a good understanding and knowledge of economics. You're talking about Stanford, Harvard, MIT. He would bring policy-making experience, the NEC and the Fed. He would bring private sector experience. He understands the functioning of the capital markets. It's not often that you find someone who can operate at this intersection of economics, finance, and policy. And it's not often that you find someone who not only can operate there, but can communicate well. And we do need much better economic communication.
Mohamed, I've said this a few times, and I'm sure you'd agree. It's good news that the caliber of all the candidates is so high, given the challenges they'll have to confront in the next several years. As we look ahead to 2025, could we go through a few of those challenges right now? What do you think the biggest are for the incoming Treasury Secretary?
I think it's maintain economic growth. John, I can't stress how important that is. It is important to deal with problems of inequality. It's important to deal with the debt issue. The best way to address a debt issue is through economic growth. And we are looking at a major transition, which is ongoing, from old engines of growth to new engines, or what economists call the old model of growth to the new model of growth. And the Treasury Secretary will be the lead person in figuring out how we navigate all this.
Mohamed, if it is someone like Kevin Warsh and everyone knows his end game is the Fed, does that blur the line of Fed independence?
I think you summed it well, that line has been blurred before. But I suspect that if Warsh gets the job, he's going to be really careful as to what he says on monetary policy. He will respect that line. It's also not clear that the president-elect will commit to a second step for Kevin Warsh. I suspect that he will say he will keep his options open. So I don't worry about that, Anne-Marie. I just look at Kevin as someone who, both as Treasury and Fed chair, I think would do a really good job.
If this drags on, we were supposed to get a pick yesterday. If we don't get one today, if this continues to drag on, Gary Cohn reminded us all yesterday that his pick, his nod, and also Mnuchin's nod came after Thanksgiving. Is that in itself a market negative, given the fact that we have all these other nominees floating around for the incoming administration, but we don't have this one key name for the market?
Yeah, I thought Gary's interview with you yesterday was really good because he said two things. One, as you just mentioned, he said, look, I didn't find out till after Thanksgiving. And then the second thing he said is look at what we inherited then, including some unanticipated development compared to what the new team will be inheriting now. So I don't think it's a market negative. I particularly don't think it's a market negative because, as John said, there are credible candidates being considered, or so we're told. So no, I don't think it is a market negative. I think it's the right thing to take time to make this decision.
Mohamed, I thought of you a lot this morning when I saw the flows for the past week into bonds and stock funds in the U.S. And I saw the outflows, the dramatic outflows from European bond and stock flows. And I thought about your comment about that sucking sound of capital away from the rest of the world and into the United States. And I have to wonder, are there limits to this? Because basically the fact that everybody else's pain is leading to the U.S. gain is also leading to higher rates that the rest of the world is going to pay for. In other words, they're going to pay for that debt because of the attraction of interest rates. When does that kind of balance out? Do people get sick of this story?
Not for a while. And I thought of all three of you because I remember when we were together last week and we talked about the global economy and I told you the good, the bad, and the ugly, and I put Europe in the ugly, saying there really is an issue there that as both secular and cyclical headwinds come together. And today's PMI numbers are a clear reminder that there is this problem, and it's getting deeper. We know what the solutions are. There is the Draghi report, but there is no political will to implement it. So the U.S. will continue to diverge. Like you, Lisa, I think divergence is a really important theme for the next 12 months. Is there a limit? Sure, there's a limit at some point, but we're not there yet. And the worst thing is to sacrifice U.S. growth in order to get lower rates. That would be the U.S. is the only engine of global growth right now. So you do not want to sacrifice the only engine of global growth. What you do want to happen is both for China and for Europe to get the act together and to transition to healthier and higher growth.
I have to wonder also how much this pushes central banks around the world to keep investing in gold and try to diversify away from the dollar, because at some point there has to be some anger or at least a feeling of frustration that everybody else is at the whims of the United States in terms of whatever kind of fiscal situation they want to implement, and that the fiscal dominance allows them to do that. How much do you see that kind of trend in gold, in other asset classes really continuing as people look toward a day that maybe could be a different regime with respect to the dollar?
So this trend, which we have seen now for a solid 12 months of trying to diverse away from both the dollar as a reserve currency, and importantly, looking to diverse away from the dollar system as a payment system. And I worry much more about the second than the first. The trend is there. And for the reasons you've cited, on the currency side, at the margin, and I want to stress it is at the margin, people are looking to diverse away from the dollar into gold. The payment system is a reaction to the worry about weaponization of investment sanctions and trade. So that is ongoing, and we have to keep an eye on it. Now, we're not anywhere near critical mass. There is nothing to replace the dollar at the center of the system. There is nothing to replace the dollar payment system. However, you don't want alternatives as clunky and as inefficient as they are to gain momentum.
Which is why we're seeing the dollar depreciate against gold, depreciate against something like Bitcoin. But I think we have to take a step back and recognize what it's not doing against other currencies. We're facing the prospect of an 8 consecutive week of strength for the US dollar, for dollar index, for DXY. Mohamed, the why is because the data in America has been pretty decent, and we're rethinking the Fed's path. Matt Lazzetti of Deutsche Bank had this to say in his outlook. Growth is too fast, inflation is too furious for Fed cuts. Our baseline sees a 25 basis point cut in December, calls it a close call, goes on to say after that we expect an extended pause which keeps the Fed funds rate above 4% into 2026. Is that your base case too?
So my base case is they cut by 25. When they come to their next meeting, they'll have clarity on 3 things that will impact how they see the economy going. They'll have clarity on tariffs, they'll have clarity on immigration, and they'll have clarity on where the budget is going. And they'll build up that clarity as they go into the year. And that is what's going to determine whether they do more or not. They're going to see how these 3 things. John, these fundamentally impact. First, tariffs will impact price behavior. You see this in the UK. Companies now have gotten much more used to passing on any increased costs. So in the case of the UK, the supermarkets have come out and said, you know what, the higher national insurance contributions, we're going to pass on that to prices. And demand here is not as strong in the US as it is in the US. So tariffs will have an impact on pricing behavior by companies. Immigration will have impact on the labor market. And of course, what they decide on taxes in particular, which will come ahead of what they do on spending, where they're looking to cut spending, will have an impact on issuance. So the Fed is going to have to step back and look at these 3 things and then decide how they fit into this big puzzle.
Let's finish on that word clarity. They'll have clarity on tariffs. They might have clarity on what the approach might be, how big the tariffs will be. They may not have clarity on the effects. And this is something you touched on earlier this week when you talked about things like trade flows, corporate pricing, demand-supply elasticities. How long does it take to get clarity on the effect of those tariffs?
Yeah, and that list goes on, John. Game theoretics, statecraft. I mean, it is a very complex issue, and the media has tended to simplify it, oversimplify it. No, they'll need time, but they'll have a clarity on how serious is the direction of travel. And that's going to be important in how they think about what policy rates should do.
Mohamed, we appreciate your time. We're lucky to catch up with you, sir. Thank you. Mohamed El-Erian of Queen's College, Cambridge, on the latest in the United States and beyond. We'll talk more about Europe a little bit later this morning. We'll catch up with an ECB Governing Council member in about 15 minutes' time. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Large parts of the Pacific Northwest are without power after a major storm moved through Northern California and Washington. A bomb cyclone has killed at least 2 people and led to widespread flash flooding and rock slides. A flood watch is in effect into Saturday for areas north of San Francisco, with dozens of flights canceled. Conditions are expected to continue into the weekend, with another 6 to 12 inches of rainfall expected. Meanwhile, U.S. Securities and Exchange Commission Chair Gary Gensler plans to step down on January 20th. President-elect Donald Trump had vowed to fire Gensler, who was tough on crypto and other markets. Trump can immediately choose a replacement for the position. And baseball's biggest stars have been crowned. Yankees slugger Aaron Judge and Dodgers phenom Shohei Ohtani were awarded MVP once again. For Ohtani, it's his third MVP in 4 years after he became the first 50-50 player in history and helped the Dodgers win the World Series. He's now the 12th player ever to win the award 3 times. For Judge, it's his second time winning the award, leading the majors in most hitting categories this season, including home runs and RBIs. Both players were voted for the awards unanimously. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in 30 minutes. Up next on the program, the bond market taking center stage.
What is the binding constraint for Trump to be able to enact his agenda? And I think it is a move on the long end of the curve, where we would be seeing kind of possible concerns of a second wave of inflation.
That conversation up next, live from New York. Good morning. Big rally in the European bond market this morning, down 11 basis points at the front end of the German curve off the back of weaker than expected data. Yields lower stateside by 3 basis points to about 4.39. That differential push it through foreign exchange, weaker euro, stronger dollar, euro dollar about 104. Under surveillance this morning, the bond market taking center stage.
What is the binding constraint for Trump to be able to enact his agenda? And I think it is a move on the long end of the curve, where we would be seeing kind of possible concerns of a second wave of inflation. Bringing up the cost of government debt would be probably the thing that would cause Donald Trump to pull back on the reins and tell his Commerce Secretary, tell his Treasury Secretary to do the same. In Trump 2.0, I think the bond market takes center stage, where Trump 1.0, it was the equity markets.
So here's the latest this morning. Republicans preparing to push Donald Trump's economic agenda through Congress, potentially adding trillions to America's debt pile and pushing the Treasury market to the top of the White House's scorecard. MacGuineas of the Committee for a Responsible Federal Budget writing, with the national debt approaching record levels and interest costs exploding, lawmakers will need to consider substantial spending cuts and revenue increases to put the national debt on a more sustainable path. Maya's with us now for more. And Maya, you've got a note that's music to the ears, I think, of the Department of Government Efficiency. You say there is $700 billion of easy deficit reduction. Help us find it. Where is it?
Well, so one of the great things that the DOGE committee can go after is that in many budgets in past years, both Republicans and Democratic presidents alike have put forward a number of changes that are similar with each other. And so that's a great place to start if there's been bipartisan support. We know where the biggest areas of savings are in the federal budget, and they're not the small, like, laugh line items, and they're not in getting rid of federal workers, though both of those things are things that should be done. But they're in sensible health care reforms, like site-neutral reforms in Medicare, kind of technical issues that the experts have been looking at for some time. They're in how we do procurement. They're primarily in the healthcare area and the national security area. I'll remind people that the Defense Department fails its audit every single year. There's lots of ways we can change things there. And there's ideas for how we change the accounting, computing, financial systems of all the government agencies, which right now aren't even able to talk to each other. So while DOGE has been talking about regulatory reforms and bureaucratic reforms, the biggest areas are going to be in savings and that $7 trillion budget.
Well, in the Wall Street Journal this week, they talk about $500 billion plus in annual federal expenditures that they say are unauthorized by Congress or being used in ways that Congress never intended. They cite things, Maya, like Corporation for Public Broadcasting, Planned Parenthood, and some grants to international organizations. Would that actually get bipartisan support?
Excellent question. So I think there's something to be said by having outsiders who go look at the budget with a fresh pair of eyes or a couple fresh pairs of eyes. But they're also going to run into a lot of roadblocks because they're not familiar with how Congress gets things done. Yes, there's about $500 billion in unauthorized funding in the federal government. Much of that is because there's so widespread support for those programs. You named something. The biggest item of unauthorized spending is veterans benefits. That's the area that has just swept through Congress in past years of getting increases, bump ups, nobody's going to step back from veteran spending that I can imagine. And so I think they're going to bump into a lot of roadblocks there. Many of those programs are unauthorized because they just jumped to the point of putting them through the budget. So the big question, as you point out, and as it should be, you can't just have outsiders saying, this is what we're going to cut, this is what we're going to toss out. It needs to go through Congress, and Congress has a lot of preferences that will not align with the kinds of things that are being floated, I think.
If you make people come back to the office who are government workers, will that allow enough attrition to really save the money that is needed?
That's not the right way to do it. Now, I think that talking about having people come back to the office, absolutely the right policy. But what you really want to look at is what agencies are bloated. Department of Agriculture, for one, has more people than it needs to do the jobs it does, by all accounts. And what departments, even with the savings and with the regulatory reforms that they're talking about, wouldn't get the same amount of savings by arbitrarily cutting people. You don't want to take a meat axe to this. You want to think about where there are redundancies and inefficiencies within personnel, and that's how you think about it. So coming back to the office, yes. Using that as a way to slash your workforce, no, we should think about it much more carefully than that.
Maya, in your note, you also talk about the fact that Presidents Reagan to Biden, even Trump, were talking about how to really fortify the IRS and that tax gap. But when the Biden administration tried to make the collecting taxes easier, the Republicans really pushed back on this. What kind of appetite are they going to have in this Congress?
Let me tell you, that's one of the things I'm very worried about. So as a fiscal watchdog, we don't believe in free lunches. Very few programs pay for themselves. Tax cuts don't. Spending increases don't. Putting money into the IRS is one of the very few areas where you can actually get multiples return on what you put in, just because it needs more help so taxpayers know what they're doing and that there's enforcement in certain places. Sometimes we talk about it in a way that makes it sound easier than it is, but this is a very productive investment. I'm worried that rescinding those IRS dollars will be used as a slush fund to offset other bump ups in spending. We have spending caps for this year, if they ever pass a budget for this year, which they don't appear to be on track to do. And Congress will be trying to get a way around those caps. Getting rid of the IRS funding isn't the right thing to do, in my opinion, because it does pay off. But you see a lot of support from Republicans for rescinding those dollars. Absolutely.
Maya, a lot of people who come on our show say that the ultimate punisher, the ultimate check will be the bond market. And I'm looking right now, and yeah, you've seen yields go up on the long end, but this hasn't been some sort of mass bond vigilante protest that has caused a complete change in the tone in Washington, D.C. What would be required to sort of get the attention of people in D.C. for imminent action in the bond market at a time where a lot of people are saying, well, you know, you still see a lot of people willing to buy?
Yeah, I thought that point that your previous guest made about all eyes will be on the bond market, whereas in last term, all eyes were on the stock market. I thought that was an excellent point. There are real risks right now. There are real concerns in the market that we haven't seen in past years. And I think if there are signs of inflation and if there are signs of those rates continuing a steady march up that are driven by concerns about the excess of borrowing that it looks like we may be on track to go on, that the administration will rethink some of its plans to borrow. It has plans to do a lot of borrowing up front and then talk about spending cuts or savings down the road. That's not how you're going to reassure markets. They should pair those two together. And so that the so-called bond vigilantes will understand that all the policies that the Trump administration is talking about won't add to the debt, because if that's what drives up even small ongoing increases in the bond market, I think you will hear more and more growing concerns about it.
I hope you get to speak to Elon Musk soon, because I know you've got tons of ideas. MacGuineas there, the Committee for a Responsible Federal Budget. Appreciate your time. I wish they could simplify taxes in this country. If you're W-2, and we are, withhold the right amount. Don't make me guess at the end of the year.
Yeah.
I'm not doing deductions. Why should I need to do a tax return?
I couldn't agree more. Make tax returns great again.
Right? Why,
the UK does it like that.
This is not difficult.
Simple.
I would agree. Who likes doing taxes? Actually,
nobody.
They can be kind of fun.
Still recovering from the idea that Lisa enjoys taxes. Not letting that go. It's the most Lisa thing ever.
Yeah, you can kind of see it, right? Well, it's cathartic. It's just sort of
enjoy the pain
finishing
of doing
something.
it.
It's just, plugging in numbers and making them all add up. It's great.
Right.
I'll give you my
Futures,
taxes.
Negative by 1/10 of 1%. Mine too. on the S&P 500. On the Nasdaq, we're down by about 0.2 with some movers this morning. Your morning movers with Manus Cranny. Good morning, Manus.
Jonathan, good morning. You're learning pretty much everything that you thought you knew about the discounters this week. Ross Stores come in and they are saying, look, we're going to guide to the upper end of our band, $6.10 to $6.17. So that's moving up in terms of the guidance. Lower, here's a shock headline, lower income consumers still feeling pressured, but they are able to eke out margin expansion. Freight rates are a little bit lower and they're not having to discount just as aggressively. So that is bid this morning, $47 billion market cap. Compared to, roll it over, have a look at Gap. This is a shocker, 47 billion to 8 billion, and yet the sort of marketing presence of Gap is so much more. Think of Old Navy and Athleta capturing 7 quarters of straight gains in sales. They've raised their guidance as well. Richard Dickinson certainly delivering on reinvigorating the brand, the merchandise. Jennifer Hudson obviously collaborating with them as well. And they've only got a 10% exposure of their supply chain to China. That's going to become the go-to stat that you want to sort of gallop through the S&P 500 along with the rest of the stocks for next year. Hospital stocks are under pressure. So this is the personification of just one of them, but it encapsulates 8 days of pain. 8 days of uncertainty, 8 days of the risk of a sledgehammer to health. There's going to be a shake-up, whatever way you talk about it and look at it. Hospital stocks, biopharma stocks, we're aiming towards a shake-up under this Trump nominations of RFK Jr. and Dr. Oz. This is merely a personification of 8 days of angst. Jonathan.
Manus, thank you, sir. We'll catch up with you again in about 60 minutes' time. Under surveillance this morning, President-elect Donald Trump considering Kevin Warsh for Treasury first and then the Fed. The Wall Street Journal reporting Trump discussed the potential agreement, the arrangement with Warsh early this week at Mar-a-Lago. Ukraine saying Russia launched a new kind of ballistic missile. President Volodymyr Zelensky saying the weapon had all the characteristics of an ICBM. Russian President Vladimir Putin saying the attack was retaliation for Ukraine's use of Western missiles early this week. And finally, Apple is racing to develop a more conversational version of Siri. As competition with OpenAI's ChatGPT and other virtual assistants continues to ramp up, sources telling us here at Bloomberg that the new Siri uses large language models to allow back and forth conversations. It will eventually be added to Apple Intelligence.
Okay, that's so dangerous. I mean, honestly, I know that when we got Alexa, the kids immediately went to it and started asking all sorts of questions. Do you like me? Do you like yourself? When did you die? I mean, all of these questions, so you can just imagine.
This sounds existential. So basically what you're saying is maybe this is a Siri that can also become a friend. What I find so striking about this, and great work by Mark Gurman, who scooped this, is this wouldn't even really be rolling out till 2026. So we're talking about it now, the end of 2024.
How are you keeping it together?
How long do we have to wait for this to actually come out? But it's needed. Because I remember once I was asking a guest a question, and it picked up on, I didn't even say Siri. We need a better version.
What goes on at Lisa's house? That's what we all want to know.
Well, it's just you want to test the limits
Sure.
of what's
All right.
in the program, and now the limits will be that much widened.
Let's turn to Europe. Traders ramping up bets on a jumbo rate cut in December by the ECB as Eurozone PMIs contracted in November, feeling concerns about the state of Europe's economy as it faces down the prospect of higher tariffs from the incoming Trump administration. Joining us now is a man who has a say at next month's meeting, the Portuguese Central Bank Governor, Mario Centeno. Governor Centeno, thank you for being with us, sir. We appreciate your time. It's important to point out that every official on the Governing Council has a different view. And at a time this morning where people are questioning whether the ECB is behind the curve, I think it's important to highlight your more recent comments suggest you are very much ahead of this weaker data, anticipating it and worried about it. We'd love your reaction to this morning's economic data and whether you believe a 50 basis point rate cut should be on the table at next month's meeting.
Well, thank you for having me, and good morning from London. Well, we have to take this data in the context of all the information that we now have to take a decision next month. We will have also new forecasts. My first reaction is that this data certainly confirms the appropriateness of the decision we took in October, and the profile that we now have for the trajectory of interest rates also going forward. This is the appropriate message that I'd like to send. We know, the challenges ahead. We know that the euro area economy is struggling to recovery. The most important, though, is that inflation is on target, and we need to move according to all these data. Today's information goes along the way, indeed, I have been looking at the European economy. It just confirms that we need to move with monetary policy.
Governor, how quickly you move is part of the conversation, and whether you should be constrained by 25 basis point increments or not. Do you believe larger reductions should be considered in a month from now?
Well, we have been discussing that for a while. I rather prefer us to move gradual, and gradual means steady and with predictable steps. But of course, if the data confirms that the risks to the downside in growth materialize, that the numbers for inflation that we still are expecting these months go in the same direction, we can certainly discuss and be open to discuss different steps. But what is more important is to send a message of we are doing our job, we are moving interest rates in the right direction, and we will continue to do so as long as data requires.
As you know, and from listening to you and your colleagues, the focus so far has been on normalising interest rates, which speaks to that gradual approach. Governor, when I look at the data out of Europe, when we all do, when we see Germany barely growing and the PMIs in contraction, I think quite rightly the conversation is changing in financial markets to whether you need to be accommodative, whether we should be constrained by this idea of normalising and moving in gradual steps, or whether we should be open to becoming accommodative and moving much more quickly. What's the difference between the two for you?
We do know that we are still in restrictive territory. The interest rate is above the neutral levels, and so this means that the path going forward will be to continue to reduce the level of interest rates. We also know that the biggest problem in Europe is investment. And investment is certainly quite sensitive to the interest rate, so it will be also of importance for us to have the support of the economy so that inflation can remain at 2%. We don't want to go below 2%, and for that we need a stronger economy. So it's the combination of those two that need to be on the table so that we take a decision that so far brought us in a stable path, which is always important, to 2%, and now we need to make sure that we continue there.
Governor, if I could put you on the spot, a pointed question. Do you believe the biggest risk right now is above target inflation or below target inflation? And I'm not talking about next month's data. I'm thinking about a medium-term view, looking out several years. What is the biggest risk, above target inflation or below target inflation?
Well, the history of Europe in the 10 years prior to this inflationary experience was below target inflation. And the fundamentals for the European economy didn't change much. So, in my view, we need to be concerned with below target inflation. The risks that we face today, both from the economy and from shocks outside Europe, take us in that direction. So we need to focus on not going below target in terms of the medium term, because then we open up again the issue of, as you are saying, normalizing monetary policy. We were successful thus far to bring inflation to 2%. Now the job is a little bit different. It's like, you know, this last mile not being a pass from above the target, but from below the target. And it's not easy. It proved not easy for the Eurozone to bring inflation close to 2% before 2019, and we need to be very serious about it.
How much do you think that on a broader sense the ECB needs to consider I don't want to say a dual mandate like the Federal Reserve, where you're looking at employment as well as inflation, but the growth backdrop as well, as maybe there's going to be that bumpiness that you talk about in the near-term path of inflation. But the longer-term path, you see that risk as significantly to the downside when it comes to that disinflation.
Well, I don't think we need to discuss the dual mandate or the single mandate that we have. We just need to remind ourselves that inflation is an endogenous variable. It is strictly connected with the way the economy goes. By targeting inflation, we are somehow looking at a broader set of data and see how it interacts with prices. The labor market, certainly unemployment, employment, the dynamism that the European economy had recently on the labor market is very important, and it's also our job to protect it, to preserve it. That's not because of the labor market on its own, which is already important, but it's on the impact that this may have on inflation. We do know that an economy that doesn't grow, that doesn't invest, will not be compatible with prices at 2%. So I always look at this in a more broad sense. So for me, honestly, the thing of the dual mandate is not an issue.
Governor, you brought up shocks from outside of Europe. I'd like to talk about those shocks with you. The prospect of a change of policy in the United States following the US election, and whether that introduces a new risk that you have to confront. If the walls go up, if the tariffs go up in America, and we're all concerned about overcapacity in China, there's one place that's going to have to eat that overcapacity, and it could be another disinflationary threat. That's Europe. Yep. Can you walk me through your understanding of the policy changes we might see in the next year and the kind of risks it introduces to your outlook?
I totally agree with you on the way you put the risks that the tariffs and the spare capacity that we see around the globe will imply to inflation. So I see these shocks from an economic policy perspective as a wake-up call for Europe. Europe needs to move from the passenger seat that very often we see Europe sitting comfortable to a more leading role in the world. That will call for an increased role for the euro internationally. We were discussing that back in 2019, just prior to COVID. We may be facing the same challenges right now, so we better focus on the response that Europe needs to do and to produce to those challenges instead of discussing what is going on elsewhere. We do know that we need to move very fast if we are presented with these challenges. If I may, I can quote here Elvis Presley and say to you that we can't go on together if those challenges from the outside present to Europe challenges that Europe cannot go along with.
So for the past couple of months, the ECB terminal rate is expected to be something like 2.5% by the end of next year. Putting Elvis Presley aside, given all of the potential external shocks and the current trajectory, do you think it ought to be much lower than that?
Well, I don't see reasons for the neutral rate in Europe to be much different from before this crisis. The fundamentals in Europe are pretty similar. We have a more dynamic labor market that will certainly help bringing the natural rate up, but probably it will not be enough given many other factors like demography and productivity that will still weigh into that number. So if we go close to 2%, probably below, it will be my best guess right now for the neutral to be. So we still have some way, some path to cover, and we need to be very much focused on that.
Interesting. So we appreciate your time. with a suspicious mind. ECB Governing Council member Mario Centeno. Thank you, sir. Appreciate it. A wonderful reference there to Elvis Presley. A lot to take away from that conversation.
Basically, just the need to look through any kind of near-term inflation, and that really this is going to be potentially a matter of how quickly, not necessarily whether they're going to be cutting rates aggressively.
Next month is a really big decision for the ECB. Just imagine we could have a Fed going on pause and an ECB cutting interest rates 50 basis points.
The theme of the day, divergence, as you said. I mean, honestly, this to me is really going to be highlighted, and we're going to see it in the currency. That's what we're seeing right now.
Yeah, euro dollar around 104. Up next on the programme, America's energy needs piling up.
What we now need is energy. We are prolific consumers of energy, and we're going to run out. There should be an AI for America initiative where the government works closely with the private companies and figures out a way to make sure that we are ahead of time.
That conversation up next, live from New York City. This is Bloomberg. Equity futures on the S&P 500, just a little bit softer here. We're down by 0.1%, but recovering. In the bond market, a bit of a rally. Yields lower by 2 basis points. The 10-year 4.39. The rally in Europe even bigger than that. The front end of the German curve, we're down by double digits. Lower by more than 10 basis points on a German 2-year. Unlocking a ton of euro weakness. Euro dollar earlier on in the session dropping to 103. Right now 104, a negative 0.6%. Under surveillance this morning, America's energy needs piling up.
What we now need is energy. We are prolific consumers of energy, and we're going to run out. One estimate is that the U.S. will run out of all sources of energy by 2028 at our current growth rate. There should be an AI for America initiative where the government works closely with the private companies and figures out a way to make sure that we are ahead of time. The power of this technology upends society in so many ways. Economically, the way we govern, the way we reach, language, and so forth.
So here's the latest. The energy sector poised for a critical chapter, with Donald Trump's second term set to reshape policy and the build-out of AI infrastructure putting huge demands on powering it. Raj Agrawal of KKR writing, digitalization, the energy transition and the digital power problem are massive challenges that require scaled capital and deep sector expertise to solve, but also present a tremendous investment opportunity to those with the ability to solve them. Raj joins us around the table. Raj, good morning. It's good to see you.
Morning, Jonathan. Thank you.
Thank you for joining us. Let's talk about those energy needs. Just start there. How big are they?
They're massive. If you take the data center business in the United States and you say, okay, how much power is required to power that? If you fast forward 2 to 3 years, we believe that there'll be, if you then aggregated that power, we think there'll be as much power consumed by the data centers in the United States as one of the top 10 countries in the world in terms of power consumption. So it's massive.
How much building needs to happen to accommodate that in terms of energy infrastructure?
Yeah, we believe it's about $500 billion per year for the next several years. So already we have, if you look at our own data center business, we have roughly $40 billion of assets in the ground, and we have a $110 billion pipeline. But that's a drop in the bucket, right? There's not enough capital out there to make this happen. And so we're working hard on trying to bring that capital to bear.
One thing a lot of people have been talking about when they come on this show is one of the big challenges to getting infrastructure for energy built is some of the permitting and some of the other sort of regulatory constraints. Has that been your experience too? Do you expect things to be expedited in a material way? Should there be some sort of withdrawal of some of these regulations?
Yeah, you know, it's the right question. There's a lot of constraints to building it out. So there's affordability, security. Is there just enough growth? Right? If you look back historically, power has not been a growth business. Right? It's been relatively flat for the last 20 years. We now think that there'll be about 2.5% growth per annum in power, and about a third of that coming from the data center business. And so the industry needs to respond. Part of that response might be easier permitting. Part of that response might be, more investment in renewables, more investment in natural gas, maybe nuclear coming in. So the industry is right now in a process to respond. What gives me hope is that everybody in the country wants this to work, right? This is one of the areas where the U.S. has a competitive advantage. And so whether it's Democrat, Republican, North, South, everybody's trying to align to make this happen and solve this problem. And so it gives me hope that we'll get there.
You had a statistic that I thought was amazing. The infrastructure has gone from about 1% of the private asset sphere to about 25% in the past couple of decades. And when I think of infrastructure spending, I think of airports and toll roads and LaGuardia. And yes, it's gotten a lot nicer. Is the majority of that infrastructure at this point largely the energy space and anything related to digital?
Yeah, if you look at how capital is being invested, I'd say it's roughly about a quarter in the digital space, probably a quarter in energy, including supporting digital, but also much more. Right? There's a whole electrification business that's much broader than just digital. There's asset leasing, transportation. So the typical airports, toll roads, maybe less than 10% of what's happening in the industry today. And therein, I think, lies the interest. Why has infrastructure gone from 1% to 25%? If you can invest in infrastructure with great assets and long-term contracts and protect capital, but expose capital to sectors like power and digital that have a ton of growth, you now have the potential for a tremendous risk-return profile. Protect capital regardless of what happens in the macro, but be able to generate attractive equity returns by all the growth that's there. That's what's really driven the interest in infrastructure.
Do you expect more deals like we saw at Microsoft and 3 Mile Island, basically restarting this nuclear plant? We've never seen that before happen, this restart like that.
Yeah, I do. So, nuclear specifically will take a while, right? This is the beginning of a lot of permitting, regulation, and capital expense. So, nuclear might be part of the solution in 5 or 10 years. I think in the near term, there's going to be natural gas-fired power. There'll be a massive build-out. This will be a renaissance in investing in power, including renewables, wind, solar, power transmission, distribution. Nuclear would be part of it, not just a 3 Mile Island type project, but also small nuclear modular reactors. And so I think that's probably solving the 5 to 10 year problem, not the 0 to 5 year problem.
Just to broaden out to follow on to that question, how much of the money, and I know this is sensitive, you can't really disclose who your investors are, but how much are you raising capital from big tech themselves to actually invest on their behalf to get some of these projects started?
Yeah, they're traditionally not massive funders of us. Right? And frankly, I'd say they only have, their capital problem is not substantial. So they have tremendous capital to put after this. When they're partnering with us, they're not giving us capital or they're looking for a capital. Mostly they're looking for capabilities. Our ability to be a solutions provider, to come to the Microsoft, Google, the hyperscalers of the world and say, we've got land and permitting, we've got power capabilities, right? We've been one of the largest power investors in the last 20 years. We've been one of the largest data center investors in the last 20 years. To bring those capabilities and to give them high level of certainty that we can deliver powered data shell when they need it, that's incredibly valuable. And so that's what we're trying to do.
We're only scratching the surface here. This is going to be huge for years to come.
Honestly, the idea that we talk about American exceptionalism, the whole show has basically been Europe, things are really rough. US, wow, such growth, it's incredible. And basically, you have to wonder who's going to be financing it and how much of that's really going to come from the energy sector.
You said it. Mohamed said it a few times. Mohamed El-Erian, that sucking sound is just capital rushing into the United States.
You could see it with the flows this week. Basically, you have outflows from European bond and stock funds, big inflows into the United States.
Raj, it's good to see you. Appreciate your time.
Thanks you very much.
Thank you.
Appreciate it.
Raj Agrawal there of KKR. Coming up on the programme, we'll catch up with Yardeni of Yardeni Research, Telsey of the Telsey Advisory Group, Tiffany of Pimco, and Troy Gayeski of FS Investments. The third hour of Bloomberg Surveillance. Up next.
I think we're renormalizing a yield curve. If we've taken recession fears off the table.
As long as the underlying components and sort of drivers of inflation are still disinflation, I think it lets the Fed keep going.
They probably sneak in a cut in December, although even that's gotten to be a close call now.
I think that they can probably still go ahead and cut by 25 basis points in December, but next year is rather uncertain.
The objective has been to hold this soft landing, and now we're going to have melding.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. The opening bell about 90 minutes away. The score's shaping up as follows on the S&P, on the Nasdaq, on a Russell. The S&P 500 just a little bit softer through most of this morning. On the S&P 500 right now, recovering but still lower by 0.1%. We're down 0.2 on the Nasdaq. We're in positive territory on the Russell. The small cap's up by 1/3%, with a bit of a rally in Treasuries, a much bigger rally over in Europe in the bond market, and a much weaker euro off the back of that. Euro dollar 104.10, negative by 0.6%. We talked about it all through the morning. The word of this morning, divergence, weakness in Europe, and better data in the United States.
I have to be honest a little bit. I feel a little bit guilty that we're talking about the pain of Europe and these PMIs and contraction, and then we're saying, look, it's going to be, the golden era, and we're going to see such building and investment, et cetera. And you have to wonder, what are the limits to that divergence? And I think that's what people are going to be testing, and how much are we maybe overstating one or the other. But for now, very much front and center is the fact that Europe has a problem of secular stagnation and stagflation at a time where the United States is very much in a different picture.
This is years in the making. Jonathan, you've said it a million times. America innovates, Europe regulates, China replicates. And that's what we're seeing happen. And it's going to be far worse for Europe when Donald Trump gets elected. And the Portuguese central bank governor said this. He said, quote, "We're going to be dealing with shocks from outside of Europe." How much more difficult and challenging is the European environment going to get when the United States puts the tariff walls up?
They've got to balance a bunch of competing issues in Europe at the moment, but I think the dominant one, to your point, is the shock outside of Europe. How big these tariffs might be. And what it will lead to ultimately is a disinflationary impact on the European continent, potentially, that they're going to have to grapple with.
Especially at a time where potentially China is going to be trying to export their goods to someone, and they won't be able to get them to the United States. So they'll be exporting cheaper goods to Europe, and that's going to create that downward kind of trajectory. Christine Lagarde came out and was talking earlier today, and she said this. Since last year, Europe's declining innovation position has come more clearly into light. The technology gap between the United States and Europe is now unmistakable. Real question is, how do you invest at a time where you're just trying to basically protect the fiscal picture, and it shows the difference of the fiscal dominance of the United States, the ability to borrow at a time of already strength?
Germany is at the heart of this. The German model has totally failed on three key fronts: energy security, broader defense, and then economic security as well. Across the board, relying on America for defense, big crack in that. Relying on Russia for energy, huge crack in that, demolished over the last few years. Relying on China for economic security, compromised by that repeatedly. And the list goes on.
Which is the reason why, when you see the German ECB members, it is a bit ironic that they're the ones that are most reluctant to lower rates significantly at the ECB at a time where people are talking about weakness and the need to potentially even stimulate, not even get back to a neutral rate. Mario Centeno of Portugal on just with us moments ago, saying that he sees the neutral rate potentially as around 2% or below that at a time where the collective view on the ECB is at about 2.5%.
This story's changed so quickly in just a few months, hasn't it? It's kind of ridiculous. In the summer, we're talking about Chairman Powell getting really, really dovish. 50 basis point rate cuts. We had this big dollar long built up. We were going to eat into that dollar long. We were now going to be dollar short. And then here we are again talking about building up a dollar long for a whole bunch of reasons.
And there have been a number of notes over the past 24 hours talking about how much of this is Europe and how much of this is the U.S. And the answer is yes. It's both, right? I mean, basically, you have a better than expected data coming out of the United States and weaker than expected data coming out of Europe. The real key question now is what policies are going to be put into place in the United States, and how much will we make good on the expectations or then some? George Saravelis of Deutsche Bank saying that only 30% of the Trump trade has fully been priced in, and talking about he expects a lot more euro weakness to come.
It's not that the United States won't be without its challenges. And whoever's going to be the Treasury Secretary, whoever it is going to face some big challenges as well. Check out the names. You know them well. Bessent, Walsh, Mark Rowan, Senator Haggerty. The list is about 4 people deep. There is the prospect, of course, that Donald Trump, the president-elect, gets fed up with all of this and just throws out a completely different name in the next few days.
There is, and potentially we're going to get the name today. I think yesterday we were very close. The issue was with Matt Gaetz stepping aside. They had a deal with the Attorney General, so we had 2 AG nominations in 8 days, and we have yet to have 1 Treasury nomination since the election, and everyone is waiting for this. But as you said, the caliber of these names is so well known. Also, they're being backed by also
Huge names.
Big names. Steve Schwartzman for Bessent. Yesterday, Ken Griffin telling Shonali, Mark, please take the job, talking about Rowan. Mohamed El-Erian coming on this program, talking about how he likes Kevin Warsh. So there's a lot of momentum going into this for whoever Donald Trump
I mentioned
selects.
this quote yesterday from Marko Kolanovic, formerly of JP Morgan. I think this is such an important quote. The issue in selecting a Treasury Secretary is not who can act changes, but who can best manage the market response and volatility that could undermine those changes. It's a big focus for all of us over the next few years. Coming up this hour, Ed Yardeni of Yardeni Research on the risk of higher inflation. We'll catch up with Dana Telsey of the Telsey Advisory Group as consumers prepare for holiday shopping. We'll speak to Tiffany Welding of Pimco on the odds of a December pause. We begin this hour with equities declining and bond yields falling. Ed Yardeni of Yardeni Research looking ahead to next year, writing a legitimate worry is that inflation expectations could rise, keeping long-term bond yields elevated and eroding confidence in the Federal Reserve. Ed joins us now for more. Ed, welcome to the programme. Any sign in financial markets right now that that's developing?
Well, look, I think the Fed always is a key story here. And I think the key story is that the Fed officials still believe that the federal funds rate is restrictive and it needs to be lowered. And the last word we got on their median forecast of where the Fed funds rate should go to get us to nirvana is 2.9%. I think we're in nirvana now. I mean, correct me if I'm wrong, but isn't it nirvana to have an unemployment rate of about 4% and inflation at about 2%? So we're there, and I'm wondering whether they're just going to stimulate an economy that's already pretty hot.
Ed, you talked about the melt-up and the potential consequence if they keep stimulating a hot economy. We talked earlier with Cameron Dawson of New Edge, and she was saying that she sees two scenarios. One, a choppy path where you still see some gains in equities, or potentially a bubble of sorts really percolating up, and that's something that you've talked about. How much do you see that now as a more likely outcome, given the fact that you do believe there is stimulation into an already hot market?
Well, when the Fed lowered the Fed funds rate by 50 basis points on September 18th, we did actually increase the odds of a melt-up from 20% to 25%. We're still using 55% as the subjective probability for a roaring 2020 scenario. And the remaining 20%, I think I got it adding up to 100, but the remaining 20% is for geopolitical risk, debt risk, tariff risk. It's kind of a bucket for everything that could go wrong. But clearly, if the Fed keeps stimulating here, and again, with the economy doing quite well, that some of that liquidity is going to pour into the equity markets, and we're seeing that money market funds are up to $7 trillion. I mean, there's so much liquidity in the system, and for the Fed to say that the Fed funds rate's restrictive when the stock market's at an all-time record high, Bitcoin is at an all-time record high. Real GDP is at an all-time record high. I mean, I'm scratching my head and said, what planet are they on?
At the same time, Ed, somebody could push back and say, sure, they're record highs, but this is an expanding economy. And frankly, the earnings have been outperforming quite considerably and show a lot of promise. We hear about the investment in artificial intelligence and data centers and energy. How do you sort of draw the line between a bubble and something that makes complete sense based on the growth?
Well, it's a totally subjective assessment, maybe not that much, because I think we can look at the charts and see where valuation multiples are. I mean, I'm really kind of, I wish Warren Buffett would tell us why he's raising so much cash. I think it's got everybody jittery. He's just doing it. And one of the explanations is that he's concerned that everything's too expensive and he doesn't see anything that's really worthwhile. And meanwhile, he sees that some of his assets are overvalued and he's raising cash. Now, he's the founder of the the Buffett ratio, which is basically the S&P 500 divided by S&P 500 revenues per share. And he was uncomfortable in the past when it got to 2.0. Well, it's 2.8. It's an all-time record high. On the other hand, a little less concerning is the PE, but not that much less, because the forward PE currently is a 22. And back during the tech bubble of the late 1990s, it got up to 25. Tech and communications services accounts for 40% of the market cap of the S&P 500. The Mag 7 is about 30%. So, there's a lot of areas where valuation is stretched, but you're absolutely right. We're kind of rooting for what I don't know what to call it other than earnings-led melt-up. I hope that, and I do believe that earnings are going to be going surprisingly strong thanks to productivity, and that'll help a lot to keep the bull market going without stretching valuations further.
We talk about the sort of stock market being one barometer that President-elect Donald Trump will be looking at, right, and the bond market is the ultimate check. And I just wonder, at what point do you see bond yields starting to truly impede some of the euphoria that you're observing in equities?
Well, look, again, you can look at the charts, and back last year we had a mini debt crisis when the bond yield went from 4 to 5%. From August, September, and October, just in 3 months. And then we found lots of buyers at 5%. That's conceivable again, and we'll get everybody focused on the potential for a debt crisis. I think Trump actually bought some time on that because by setting up the Department of Government Efficiency with Elon and Vivek running it, we don't know whether they're going to really take the deficit problem and finally solve it to a certain extent.
Ed, we've seen task force like this in the past. You actually think they're going to be able to solve some of our fiscal debt issues?
Well, I didn't say they would do it. I said that Trump bought some time. I mean, we don't know for sure. Elon Musk, if you haven't read the book Elon Musk by Walter Isaacson, it's really a must-read, especially now. And he's got a great track record of cutting costs. He's obsessed with cutting costs. The only problem is it's one thing to do it in a company where you can hire and fire people and tell them what to do, whereas when it comes to the government, there's going to be a lot of political pushback.
Ed Yardeni, if Yardeni research, there might be some bond market pushback as well. Those bond vigilantes, that term you coined a long, long time ago, might make a big comeback, Lisa. That's a big focus for you, I know.
Yeah, although at the same time, and this is sort of the constraint, just to bring it back to the divergence between the U.S. and Europe, at what point does the pain in Europe cap yields in the U.S. because people are all going to be coming here for higher yields if yields keep going down? I mean, truly, it is sort of this question that we've been asking and exploring with the likes of Don Konstam earlier.
There's certainly an argument for that, that's for sure. Let's get you an update on stories elsewhere just quickly with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. People familiar with the matter telling Bloomberg that JP Morgan is being investigated by the U.S. Treasury Department for its relationship with the hedge fund that is said to be part of a network overseen by an Iranian oil trader. The probe is still in the early stages while the agency examines if the firm complied with all rules and regulations. Spokespeople with JP Morgan, the U.S. Treasury, and the firm involved, Ocean Leonid, declined to comment. Meanwhile, Yardeni Group shares are rebounding, but this is after $27 billion of the conglomerate's market value was wiped off. U.S. prosecutors accused the founder Gautam Adani and other executives of allegedly plotting to bribe Indian government officials to secure solar energy contracts. The conglomerate has denied the allegations. And the euro falling to its lowest level in 2 years after euro area business activity unexpectedly shrank in November. The euro has since recovered a bit against the dollar, but still, traders are raising bets the ECB will cut 50 basis points to boost the region's economy. The euro is one of the worst performers of G10 currencies over the past 3 months as the risk of tariffs under the Trump administration remain prevalent. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next, the morning calls, plus Dana Telsey of the Telsey Advisory Group on the state of the consumer going into the holiday shopping season. That's up next. The opening bell, 1 hour and 13 minutes away. Equity futures going into that look like this on the S&P 500. We're down by about 0.1%. Let's get you some morning calls. First up, Needham initiating coverage of Nike with a buy, saying the recent CEO transition is a positive catalyst. That stock is up by more than 1%. Your second call from JP Morgan raising its price target on Ross Stores to 173, highlighting the company's favourable position heading into the holiday season. That stock is up by 7% this morning. And finally, Baird raising its price target on Gap to 29, pointing to another solid quarter. That stock is absolutely ripping. Let's stick with retail. 1 week out from Black Friday and a shortened holiday shopping season, Gap and Walmart seeing higher-end consumers coming to them for value as Target sees weakening sales and inventory piling up. Joining us now is Dana Telsey of Telsey Advisory Group. Dana, welcome to the programme.
Thank you so much for having me.
Compare Target to everybody else. What went wrong there?
48% of Target sales are discretionary. They had elevated promotions, higher costs. Didn't work. You look at Walmart, which has 60% of their sales coming from essentials. And when you think about discretionary, look what you just mentioned. The Gap is gaining some momentum right now. Look at TJX. Same thing. They're gaining some momentum too. So that value shopper where there is style and product is working.
Is there an execution story there as well? What is
At
the
Target,
Gap doing right?
I think a couple things. I mean, Richard's phrase is perform while you transform. But one of the things they're doing right is the consistency of looking at the product and really elevating it today's times. Look at the wide leg denim jeans. They are remodeling some of their stores. At Old Navy, the kids' business is important. And the kids' business weakened in this quarter given the weather that was out there. Coming out of the quarter, kids strengthened. And so I think off-price value and where there's newness and innovation, consumers are going. So you have that in what's happening with the Gap brand and at Old Navy.
I want to get into policy and all of that, but what is newness and innovation right now? And we talk about this. Is it launches? Is it limited edition? Is it wide leg pants that are going to be in style for, another 6 months maybe?
No, typically denim cycles can be 3 years.
Okay.
So they can be
Sorry,
a little bit
I
longer.
take it back.
No worries. But when you think about innovation, what's new and different? What about the closed-toed shoes at Birkenstock? Selling at full price, people are buying the sandals and they're buying the closed-toed shoes. When you think about the wide leg jeans, there's a lot in footwear. Look what Hoka's doing with the new colorways at Hoka. It's interesting. Same thing at On. But you know what? You marry the product with the physical space. Look at the new remodels that are opening. If you walk Lower Fifth Avenue, the new Gap remodel, it's colors, it's got punch. You take a look at the Abercrombie remodel. They expanded the men's area. Look at the new On store. So we've got newness in product, newness in channel, and you need to have value.
Maybe Target just needs a new dog, and then they'll be just fine. But
There's work to be done.
Okay. But meanwhile,
it's more than just the dog.
Yeah, that's probably more than just the dog, given some of the performance. But there is this question about how exposed some of these retailers are to the potential of tariffs, especially if their whole rebirth depends on the ability for fast goods that they can get manufactured and brought in.
When we had tariffs the first time, everyone went to diversify their sourcing out of China. It's happening again now. Probably the one who's talked about it the most is Steve Madden, taking their percentage of goods from China down from 50% to 25%, hopefully in almost a year. Gap said it on their call last night, around less than 10% of their goods come from China. Where else are people going? They're going to Mexico, they're going to Africa, they're going to Vietnam in terms of where goods are going to be. The end result, though, and National Retail Federation talked about it, if we have these tariffs, you're going to have an impact to consumer spending that can approach nearly $80 billion. And what it requires in the apparel area, if you're going to have increased costs passed on to the consumer, can be price increases of low double digits. That's a concern across the board.
Are any of these retailers talking about coming back to the United States? Because what President-elect Trump is talking about is basically a carrot and stick approach. I'm putting up the walls, but you're going to get a 15% potentially corporate tax rate if you produce in USA.
No, some of them have mentioned some items coming back to the USA, but basically it's Mexico, it's Vietnam, it's even Africa where people are going. The labor costs are lower. They have the labor to be able to make the goods and the expertise of it. That's why the reason why everyone's in China. There is no China like China in terms of the expertise of how they make the goods. It will be a problem and a big topic of discussion throughout 25 if those tariffs get enacted.
Tariffs is one potential risk down the pipe. We also have the ports, that strikers. That deadline is January 15th. We see Target overshoot when they were building their inventory. Do you see retailers now having to build up inventory because they're concerned there won't be a deal in January?
I think overall they're watching carefully. Only Target has been the one who's called out the increased inventory that they're building. I don't really have others. As the earnings are being reported, you're still seeing inventory growth less than sales growth. Tuesday is a major day. You have all the mall retailers reporting on Tuesday in addition to Burlington. You got 10 reports coming out on Tuesday. We'll hear more, but what we've heard so far, I'm not seeing inventory pileups except for Target calling it out.
Why did they get it so wrong then?
The Target?
Yeah, how did they step on such a massive inventory landmine?
Different way of looking at things and how they're planning than everyone else. It is surprising in terms of how they stood out so much. Because when you look at Walmart, who reported just the day before, it was the other areas of business that also accelerated the growth.
When the numbers dropped, I think we all reflected on the same thing. It reminded us of spring 2022. This isn't the first time we've seen this movie, which I think is why some investors were pretty spooked by it. It's as if they haven't corrected for the mistakes they made a couple of years back. Is that a fair criticism of them, or is that unfair?
I think overall, they may have corrected then for the mistakes they made, but then looking at the macro landscape, they acted faster and made change quicker than others, while others basically are saying it takes time to enact some of these initiatives. And so, no, I'm not seeing others do that.
So you think they corrected based on the lesson that they learned in 22?
Yeah, it seems like it's way too advanced for what compared to everybody else. And you have to look at this holiday season. With a compressed season of 5 fewer days, promotions are happening. I don't know about your email inbox, but mine is filled with 8% off.
How much does that 5 days change things?
Huge. I think the 5 days is very important. It makes the Black Friday weekend that much more important because there are fewer days. People always still shop the last 10 days before Christmas, but it's going to make the retailers hit the dial on let's ante up the promotions.
I wonder if Target is sort of a warning shot in terms of competing on more the innovation and less on just price. Value has to also come with something new. And I wonder how much Walmart is exerting that pressure because they can compete in a way that nobody else can because of their product mix. Is that the takeaway from some of the recent earnings?
Well, part of it, but also look what Walmart's doing. When Doug McMillon said that their highest growth came from some of their upper income consumers of $100,000 household income, they're taking that share from the Targets of the world. And you also have to say, look at the growth of TJX, the traffic increases that TJ is getting. And frankly, even some of the luxury items that they have, they're smattered about in just select stores. But it's a driver.
Well, is Gap basically copying that? Because they said yesterday that they're also making inroads with upper middle class, wealthy patrons.
But part of what Gap is doing, look at the collaborations to your mention before, whether it's influencers, whether it's Cult Gaia, they're getting in the conversation by stepping up and saying, we're part of the brand halo that's out there of other brands who want to be and reach a wider audience of consumers that have a wider income level.
Top pick this holiday shopping season. What is it?
Oh, I think on value, I think it's going to be TJX. That's the top pick there.
Okay.
When I think about newness, I think Birkenstock is going to continue to drive sales.
I can't stand them.
I don't know. I'm looking at the clogs now. I'm not
them
too
and
sure.
Crocs. I just cannot get on board with that.
I like
Do you?
Birkenstocks. Yeah.
Do you?
I
That
do.
tracks.
Very much so. And
doing your taxes in Birkenstocks?
Totally. Absolutely.
Okay.
That's me.
All right.
Yep. I will out myself on that. I actually do think they're very
How many
convenient.
pairs do you own?
I actually only own one.
With socks, because people wear them with socks. That's
I
weird.
think it's so specific, and it's such an era. I think it lasted less than 3 years. So the people who do it now,
that's done.
I think that is so
that has a
done.
3-year cycle too.
That has about a 2-month cycle. That is a no cycle.
Dana, appreciate your time. It's good to see you.
Thank you very much.
Busy few weeks of shopping ahead of us. Dana Telsey there of Telsey Advisory Group. Up next, Tiffany Wilding of Pimco, Troy Gayeski of FS Investments from New York. This is Bloomberg. Equity futures on the S&P 500 just a little bit softer. We're down by not even 0.1% going into the opening bell. That cash opened 60 minutes away with your morning movers. Here's Manus Cranny. Hey, Manus.
Jonathan, a very good morning. Just to build on that conversation you just had with Dana there, we kick it off with Ross. Again, understanding the migration away from Target, whether it's into other places, but you're going back to flat on this at the moment. This company's worth $47 billion. They're upping their guidance for the year. And again, the lower income customer is still feeling pressure. So that narrative about where do you go to buy your essentials and your discretionary items begins to split out. Roll it over, have a look at Gap. And I like what Dana had to say here. It's about capturing market share. You've got a number of issues. But look at this. We are up 21% at the moment, 4 consecutive quarters of sales growth. Richard Dickinson is doing something right in terms of product, in terms of merchandise, in terms of reinvigorating some of the brands, Old Navy and Athleta. So roll it over. By the way, they've only got a 10% exposure to China on the supply chains. I just thought we'd finish off with MicroStrategy. Yes, you've got a careering Bitcoin towards $100,000. This stock was down 16% yesterday and change. Why? Because the original evangelist behind this stock, which was Citron Research, actually they're shorting this stock. They say you've got ETFs, you can play Bitcoin in a multitude of ways. So they were an evangelist of the stock. They said it's the only way to invest, but they say the valuation on this stock is now becoming detached, perhaps from some of the reality. They say, if anything, use this as your hedge to short against your Bitcoin. Come on, 100,000, Jonathan. I can see you in the Crocs and the socks, just watching the Bitcoin tick, tick, tick.
I wish I had the Bitcoin. I don't know about the Crocs.
And the socks.
And the
Dreadful.
socks.
Definitely
and any of
not.
that stuff. Manus Cranny, you definitely don't do that either. Let's turn to the economy. Traders gearing up for a busy holiday week of data. FOMC minutes coming on Tuesday as the debate over a December skip continues. Tiffany of Pimco writing, while recent stronger US data could have the Fed considering a pause in December and or adjusting its rate path higher in 2025, we think the broader trend is towards lower policy rates. I'm pleased to say that Tiffany joins us now for more. Tiffany, welcome to the programme. Let's talk about that trend, why you believe the broader trend still holds and we're heading towards lower interest rates.
Yeah, well, I mean, I think if we just take a step back from, I mean, we obviously had a very big election event more recently, but if we just take a step back from that, and just take a look at where we've been over the last 4 years, we've been in a very unique period for global economies. The pandemic itself, the fiscal policies that supported it, the recovery from that, and we're actually getting back to normal. And you can see that if you look at overall inflation trends. In the U.S., we are still a little bit elevated on inflation, but we're in a stone's throw. Other economies, by the way, are much closer to normal in terms of inflation. And if you look at the labor market, it's also normalized quite a bit from those more acute labor shortages. We've had the unemployment rate up. So against that backdrop, central banks should also be moving towards some semblance of normal. And we think they have a lot of room here to continue to gradually reduce interest rates across a range of economic scenarios. So, although uncertainty, political uncertainty could slow that pace down, we think ultimately still there's a gradual pace down. And we view at least the prospect of hikes to still be relatively unlikely.
Well, let's park the hikes just for a moment. You said there's still a lot of room. So underpinning that statement, I assume that means neutral is a whole lot lower than where we are. Tiffany, how much lower do you think it is?
Well, we've argued that, neutral on a real basis is probably around 1%, around the developed markets, kind of a 0 to 1% range seems very reasonable to us. If you think about that in nominal terms, so adding inflation, if inflation's kind of 2 to 2.5, that suggests a 3 to 3.5% neutral nominal interest rate. And we think that's basically where they're going. And so that within that context, again, it seems like a gradual path lower is still very reasonable. Having said that, though, we do think they probably will adjust their forecast for 2025 somewhat higher. We're looking for 3.8 from them, and that's just because the economy's been doing well. So when the economy's strong, you don't have to lower interest rates as fast, but nevertheless they want to make sure to stick that soft landing, and they don't want to overdo it. So again, that kind of gradual path lower still makes sense to us.
Tiffany, you talk about a neutral rate on average in developed markets. I wonder how much we could even talk about these averages anymore, given the fact that you are seeing this massive divergence between the U.S. and Europe, and the expected neutral rates are somewhat more different, at least according to some models, than that kind of range lets on. How are you thinking about that in terms of developed markets having a very different picture ex-U.S.?
Yeah, no, I think that's right. In Europe, the models have suggested that other countries, including Europe, have had a lower neutral interest rate than the U.S. For some time now. So that quote unquote wedge there is not really anything new. It's why ultimately the ECB, in terms of the terminal rate on their hiking cycle, they got to a lower place than the U.S. So they've accounted for that to some extent. Nevertheless, when we look across the developed markets, we do see, more weakness, more underlying weakness, more kind of subpar growth in those markets than we have in the United States. But interestingly, though, inflation has come down a similar amount around the developed markets. And that's because the U.S., despite its stronger growth, has also had a stronger supply side response after the pandemic. We've been able to increase productivity much more than other developed markets. And that we've been very exceptional at that. And we've also been able to maintain some higher growth rates in investment, specifically R&D and research, IP type of investment that tends to continue those productivity trends. So I would say overall the U.S. is looking pretty good now versus everywhere else in the world. But again, nevertheless, as inflation has come down, it still gives room the Fed to to kind of get on that gradual easing path.
One thing that a number of our guests have been talking about is that the base case heading into next year of solid growth and a really expanding economy, but without inflation, remains the same after the election, but the tails are getting wider. That what you're seeing is a greater risk of both a real super acceleration or potentially a hit to growth from some of the policies. How do you look at things, given that there could be some pretty transformative policies put into place?
Yeah, I mean, so we would agree with that, that the tail risks on both sides of the distribution have gotten wider. I think there's going to be a lot of, I think as we go through 2025, we're going to get more certainty around the policy picture. You'll have the Tax Cuts and Jobs Act, which will have to be renegotiated. Many of those provisions will expire at the end of 2025. So Congress will be going through that process. We think there's some potential for them to legislate, some tariff hikes, maybe on China or try to do others within that. And of course, President Trump will be negotiating, and there's going to be a lot more trade policy uncertainty. So how all of those things impact the economy, is complex. I think the real question is do we have an increase, in business sentiment and confidence as a result of things like deregulation and more certainty, around the tax legislation, or do we have businesses that are maybe a little less confident because they're more uncertain about trade and trade policy and how that's going to shake out. And I think we'll just have to continue to monitor this as we go through the year next year to see which one of those effects is bigger.
Tiffany, which do you think is the more likely risk, the idea of a reacceleration in inflation or a bigger hit to growth?
So we see the most likely for a more extreme reacceleration in inflation, of the type that we think might get the Fed to start thinking about rate hikes again. That kind of level of reacceleration, getting the core PCE rate back to 4.5%, that's historically more consistent with another supply side shock, an energy shock. And so that, the increasing geopolitical risks, for example, which drive energy prices higher, those would be the kinds of things that we would be looking for. I think in terms of the U.S. economy, certainly we are back to a better place in terms of demand versus supply. And so it would take, a lot more, domestic demand to really start to overheat the U.S. economy. So I think overall we're, in terms of inflation, I think we're still, pretty confident that we're getting into that 2-point-something zone. That is good news for the Fed. And then absent, a broader global supply shock, we expect, inflation to be around there. Then that doesn't say that it could be sticky a little bit above the target, certainly, but we think these pandemic level inflation rates are still behind us at this point.
I'm going to ask you a really annoying question, so forgive me for finishing, Kit. Please forgive me. Is there a payrolls number that would change your view on December? And I don't think that's a judgment on you, really, Tiffany, at all. We just know how hyper-data dependent they've been at the Federal Reserve. Is there a number that you've got in mind that might change this conversation for December?
Yeah, I mean, so I think there's more, I think the reaction to a lower number, a weaker number from the Fed might be a little bit more pronounced. So we had a noisy report in October. You had hurricanes that hit Florida. You had Boeing that had a strike. We will get some recovery in payrolls in November after those things have normalized. So the payroll report itself should be stronger as a result of that. So if we get a weaker report, there could be a bigger reaction. But I think at this point, if you get some rebound in strength, I'm not sure it moves the needle that much. I think on the other side, the unemployment rate, I think that will be, potentially a bigger swing factor. Surely if we get another 0.2 of an increase in the unemployment rate, like we did ahead of that September meeting, the Federal Reserve stands ready to react to that. They've been very clear that they're prepared to cut interest rates pretty quickly if they see a weakening, an unwanted weakening in the labor market.
Tiffany, you're one of the best. Appreciate your time, as always. Tiffany Welding there of Pimco on the latest for the US economy and the outlook for monetary policy. I'll keep going back to the calendar. December 6th for payrolls, December 11th for CPI, then a week later, the Federal Reserve.
I'll give you a number, 400K out.
Oh, yeah, 400K.
Yeah.
Very different.
300K, meh.
Did you find it interesting that I said, give me a number, and Tiffany started talking about weakness? That weakness would change the conversation the other way.
Right. But that's sort of really not where people's minds are right now.
Not
They're
at all.
looking at potentially if the unemployment rate drops back down or there is a sign of wage reacceleration, that could also do it. It's not just the employment number, as she was pointing out.
Let's cross over to Troy Gayeski of FS Investments. Troy, welcome to the programme, buddy. Last time we caught up, you said it's not difficult to imagine what it would take to get higher yields from here. We've got higher yields. We're back at about 440 on 10s, 430 on 2s. Can you imagine higher yields from here?
Oh, 100%, John. I mean, when you look at the curve, it's still inverted from 10s minus Fed funds, which, as you know, is a very unusual circumstance. And as you think forward, what you were discussing before, as the Fed gradually brings the front end to 3 to 3.5, typically in expansionary periods, the 10-year minus Fed funds is 200 basis points, 300 basis points, sometimes even higher than that. And so just as you go through this cycle, it's very logical to see a 5% or higher 10-year. And that doesn't even address this tremendous supply-demand imbalance we're going to have. We're going to issue $20 trillion of treasuries the next 10 years, assuming we don't have another, major shock to the economy where the treasury has to get much more aggressive at issuance. That's 73% of all the supply that's ever been issued that's owned by the public. Treasuries have the worst stock to flow of any major asset class. And then you think on the demand side, last I checked, the Fed is still tapering, right? They're still not only they're not buying, but they're reducing their ownership percentage. It's going to take a major shock to cause them to do QE anytime soon. The Chinese, even if we had a political solution to our difficulties, they don't have the current account surpluses to buy like they used to. So we just see a naturally steeping curve. And ironically, the faster the Fed cuts and the sooner they get to the lower end of that 3 to 3.5 range, the steeper the curve will probably get. So I just don't understand why people still talk up duration. At least you have hedge protection.
Yeah.
But in terms of attractive risk reward profile, not terribly attractive.
So, Troy, certainly I'm not in a position to offer a forecast, but I can make a simple observation. We've come close to 450 a few times, and it's been bought every single time over the last few weeks. Is there any signal in that for you?
Yeah, so I think when you think of this major cycle we've gone through, right, we're in a 30-year plus bond bull market, but within that bull market, you had very wide ranges depending upon, whether in 2000, 2002 or GFC or when the Fed unleashed QE. The same goes for a bear market, right? You move from, a one handle on the 10-year. As you know, we briefly hit 5, but along the way, there are many ranges. So I think what more trading-oriented managers are doing, macro managers, for instance, as well as, consultants, is trying to trade those ranges on the way back up. And so that can clearly provide support. I think it will take a few more Fed cuts to push the 10-year above 4.5% as we steepen further. And again, it's not that fixed income is the definition of return-free risk like it was at the end of 21, early 22. It's just hard to get excited about.
What's interesting to me is that right now you're not seeing yields at this level, sub 450, as constraining the equity rally in a material way. Do you see things differently? Do you think that it is or that it will if it gets over 450?
Yeah, that's a great point. I mean, and I think that's also a function of where multiples are in markets at any given time, right? So, we reflated back up from 15.75 to a recent high of 22.6. Very, very expensive. If you look at the Russell, it's like up to 28 times forward earnings, which is borderline insane. So in a more, constrained valuation regime, there'd be less impact. But as you back up that curve, particularly for large and mega cap tech, it makes further multiple expansion very, very challenging. And we could have these mini repeats where higher yields are causing some degree of multiple compression, which has really been the case since the end of early 22. Most of the sell-offs in equity markets have not been caused by economic weakness, revenue weakness, earnings weakness. They've been caused by gapping higher yields like we had last October, for instance.
I have to say, Troy, I get that. And the PE ratios do look like they are extremely expensive, and the valuation argument definitely is coming up a lot. And then we hear things like what Tiffany Wilding was just saying from Pimco, that productivity is getting better. What you see is that the equity is actually growing at a faster rate in certain industries than the price of the shares. I'm thinking of, say, NVIDIA, which is sort of the poster child of that. Why is that not a convincing argument to sort of put you off the concerns about valuation?
Oh, yeah. So, look, we've always said valuation is a terrible indicator of the short term, but it's a very good indicator of long-term performance. And investors should own U.S. market cap weighted indices. There's no doubt about it. I think locally, the question is, can we grow operating margins next year by 8%? And will there be a reacceleration in nominal GDP growth to lead to that, low teens type of earnings growth? That's going to be challenging. We're not knocking equities. We're just arguing that, the valuations at this point make further gains more challenging. And back in the day, you would complement that with international or small mid cap. But now, because you have so many more choices and alternatives like middle market private equity, where you have roughly half the valuation on enterprise value EBITDA that you do in the Russell, and you're enjoying 13% revenue growth, there's better choices in your asset allocation as you fade some of that recent strength. Or you don't allocate more into an overweight position to U.S. equities already, because most investors have been driven to overweight U.S. equities by just the tremendous performance you've seen. But you're going to get revenue growth, you're going to get earnings growth, operating margin expansion is a question, and you just have to be more realistic about what the forward return forecasts are.
Sure. I love to turn to the politics. A lot of this was priced in terms of what Trump plans to do. The Trump trade was already priced in. But what can you see as material impact from Trump and potentially what he might do in 2025 that's not priced in right now into the equity market?
Yeah, great question. So what we've been waiting for on the more liquid side of our business is for merger arb to come back, right? It's been a very challenging period. There's been a lot of government intervention. That being said, even during peak intervention, only 8% of deals were breaking versus 5% long-term average. So, when you think forward, our view is that, mega cap is going to continue to be challenged for acquisitions, right? That mega cap tech. There's going to be continued political pressure to block those deals. However, in other industries where there are logical mergers, like airlines, for instance, those will more than likely be allowed to go through. So mergers should not necessarily boom, but come back very strong. And then I think just as important long-term for the health of private markets is the IPO market's not going back to 2021 anytime soon, but you will see much healthier IPO activity. And those are both also very good for private credit, because a lot of the financing opportunities we're seeing now are financing upcoming mergers as well as, potential acquisitions. So without corporate capital activity, it gets much harder to generate attractive returns in certain strategies. So we're very optimistic that is not priced in, like, for instance, in banks, where you don't see Wells Fargo up 13% every day. There's still some pockets of opportunity in non-correlated strategies.
Final word, Troy. Pick a Treasury Secretary. Got a name in mind?
Morris is really interesting because it's contrary to, the Trump, we love easy money policy, right? Yep. But it does seem like there's a consensus forming around him. And it is really interesting. You guys have done great reporting on this, the natural evolution from Treasury Secretary to potential Fed chair over time. We don't have a preferred candidate, but it seems like he's been gaining steam, as you know.
The reporting is all Anne-Marie. It's nothing to do with me. Troy, appreciate your time, sir. Thank you, buddy. Troy Gayeski of FS Investments with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Citadel founder Ken Griffin said he would consider selling a minority stake of the $65 billion hedge fund. Speaking with Bloomberg at the Economic Club of New York yesterday, Griffin said he would consider selling to a firm similar to Sequoia Capital. He said, quote, "That's going to push us to be better at what we do in our business day in and day out." Meanwhile, Bitcoin is closing in on $100,000, driven by expectations of friendly U.S. regulations and growing investor interest. We're currently trading around $97,500. This coming as President-elect Donald Trump's transition team has already held discussions over whether to create a new White House post dedicated to digital asset policy. The crypto market has gained about $1 trillion since the U.S. presidential election. And Apple is working on making Siri more conversational. According to people familiar, the goal is to catch up with OpenAI's ChatGPT and other chatbots that are better able to hold ongoing conversations and respond more quickly. In order to do this, Apple plans to use more advanced large language models. The company is currently planning to release the new Siri as early as spring 2026. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Have a wonderful weekend. Up next on the programme, setting you up for the day ahead. You're watching Bloomberg TV. Live from New York City, 36 minutes away from the opening bell. Equity futures doing okay, down just 0.1%. A rally in the bond market, down 3 basis points, 4.39 on a 10-year. Counting it down to the opening bell, here's the trading diary. Through the next week or so, the calendar looks like this. Today, we get S&P Global PMIs and UMich consumer sentiment. Look out for the political breakdown of consumer confidence. That's always one to enjoy. Tuesday, consumer confidence, new home sales and Fed minutes. Wednesday, durable goods and a second GDP read. And another round of jobless claims before we get the US holiday, Thanksgiving. All eyes, of course, on Mar-a-Lago before we get there this weekend. For Donald Trump's search for Treasury Secretary, the list is about 4 people deep. We know the names pretty well. Will we get a decision this weekend?
We potentially get a decision as soon as today. You know, the thinking was this would come yesterday, and Greg Valliere talks about this morning. The fact that the messy Gates departure has 2 major implications for Trump. One of them being it stalled the delivery of this Treasury Secretary that we've been talking about for days. Wall Street Journal this morning picking up on our reporting earlier in the week that potentially there is a duo at play, 3D chess. You pick Kevin Warsh for Treasury before he goes over to the Fed in 2016. Bessent goes to NEC before then he becomes Treasury Secretary maybe in 2016. But we need to remember, this is not over yet. And Scott Bessent has the support of, I was listening to Steve Bannon yesterday in the War Room, and Steve Schwartzman. It's a pretty big swath of people that's backing him.
I'm going shopping. I think
you're going to Gap?
Yeah, I'm going to go check out the new styles at Gap, the new releases. I'm going to go check out, the retail spirit in America.
Just take a deep breath. It's only been a little more than 2 weeks since the election. All 4 names are of a very high caliber. Let's wait and see what we get.
It's the holiday season that's starting out, and so we can focus on other things too.
No, we got 2 AGs in 8 days, and we have not had a Treasury pick.
You're in a rush. I'm not sensing the same thing on this pick. They've got to get this right. Coming up on Monday, Mike Dada of Roth Partners, David Bianco of DWS, Mike Wilson of Morgan Stanley, Francis Donald of RBC from New York City. Thank you for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.